At the end of the day, we see volumes. Stocks as a result of that retail sales picture. Forward-looking US futures look entirely flat, actually. So you can see S&P futures are flat this morning. The pound is at 127.27, up 0.2%. It goes higher once again in a sort of knee-jerk response to that slightly higher than anticipated CPI print. It has stepped down a lot from last month, but still a little higher than expected. And Tom, I also mentioned natural gas prices, because once again we're being sort of whipsawed by that story. This has a lot to do with the Australian labour market, of course, and whether we'll see resolution to disputes there. A very globalised picture for gas markets right now. Tom, what do you see on futures?
Yeah, and a reminder that that energy complex could provide something of a pushback to this disinflationary theme that we've seen coming through. The FTSE 100 futures pointing lower by 0.2% after the selling of yesterday. DAX futures lower by 33 points, and over in France, losses of 0.3% flagged by these futures, Anna.
Okay, so futures points lower, expecting to see a bit of weakness at the start of the European trading day. We get the FTSE 100 then down by just a fraction, as it is the first out of the gates this morning. Here's the move in the pound we're talking about, up by 0.2%. Another reminder this morning of the pressures on the Bank of England, on the thinking around how many rate hikes there'll be from here. It seems that markets have left their expectations of how many hikes we get unchanged, but that's after they stepped those expectations up yesterday on the back of the strong wages data. So we're waiting to see what happens on the gilt market story as gilts open. There you go. I just saw there's the 30-year gilt just popping into the GMM, the 2-year. We are seeing those yields rise. And what's interesting actually is that the yields are rising on UK gilts when they're not rising elsewhere. As Mark was pointing out at the end of the last hour, we're getting a bit of a relief from August's theme, which has been around a stronger dollar and higher yields. That relief coming in the US 2-year, you can see there, and broadly across treasuries. And that applies to the rest of the European rate space, but not to the UK, where we seem to be going in our own direction as a result of what we saw on that inflation print, Tom, earlier on today.
Yeah, and selling across the main sectors so far this morning. I'll point out technology currently down as a sector 0.5%, even if yields start to moderate somewhat across the US Treasury curve. Basic resources now down a full 1%. Of course, you can tie that to the property sector in China and expectations that there's going to be less demand for the likes of iron ore and copper on the back of a second straight month of falling sales. And again, those concerns just percolating through the real estate market and the linkages to the broader financial system of China. Currently, that sector, basic resources, down a full 1%. Energy also taking a bit of a hit. Of course, you have seen some upside for oil over the last 30 days or so, but currently as a sector down 0.6%. Industrial is also taking a bit of a hit, down 0.5%, and financial services off by 0.5%. Just one sector so far in the green, reflecting what we saw yesterday. It was retail, the only sector that remained in positive territory yesterday, and so far in the first few seconds, retail is gaining just 0.1%, Anna.
Okay, so that's what we see on the sector breakdown. Let us get to what's happening on gilt markets, and actually things taking a little while to settle down this morning in terms of the gilt market trade. Got a yield on the 2-year 5.085. It seems those yields coming down a little bit now. Sam Unstead joins us from our Markets Today blog, and he's been poring over all of the details on that CPI print. I suppose in a sense there was something for everybody in CPI, wasn't there? There was the big step down at the headline level, but the number was a little bit higher than the market had expected.
Yeah, I think that refrain is almost all UK data at the moment. So there's something for everyone. There's something for the bulls. There's something for the bears. If you were going into this expecting to see inflation come down further, it didn't happen. So actually, one thing that's interesting, I suppose, is that the wage growth yesterday seems to have taken a bit of the air out of today's print. You're just saying gilt market's not moving a huge amount. They did move quite a lot yesterday. Stocks got hit very hard. It feels like that kind of took away some of the surprise from the CPI. And of course, it was only slightly higher than expected. We had actually warned a couple of times on the blog, January, we did have a downside surprise on inflation, then 5 in a row that were hotter than expected, and that's now happened again.
That's why we need to read the blog. We do. That's why the audience needs to read the blog, because you preview some of these things and you have the finger on the pulse of how some of these things may work through the markets in terms of the macro data as well. When it comes to you talk about the mixed bag in the UK. It's a mixed bag in the US as well, and we know that the FOMC now on the Fed are increasingly divided. We had the minutes out later today. What is the kind of forecast? How are we expecting those divisions to kind of play out?
I think, so we talked earlier about retail sales, still very resilient. So that has to feed into the picture again. These are obviously the minutes from the last meeting. I think what we're expected to see is a split. It's certainly in terms of how long they can pause for, if they can pause at all. I think the debate is just going to continue there for quite a long time. And it's a picture you're seeing with a lot of central banks at the moment. They're just waiting, because they are so data dependent, they are waiting for that data to all come in line with each other so that they can finally move in the direction of a pause.
Market's still pricing in a pause from the Fed. Jackson Hole next week.
Yeah.
Get a speech, of course, from Jay Powell. We'll see if that clarifies the next steps and the next direction of travel for the Fed. Sam Unstead, thank you from our Markets Today blog. Of course, you can get more from Sam and the team on the front page of the Bloomberg UK website, or by typing TLive Go on the terminal. Let's get to some of the individual stocks and equities on the move then with Joe Easton. Joe, you flagged the number for us leading in to the session. Carlsberg was part of the mix there. What else is jumping out to you?
So Carlsberg, first of all, coming down around 2%, pretty much giving up all of that gain that we saw yesterday. Quite interesting, given the guidance was upgraded during yesterday's session. We've got a share buyback today that we didn't know about. I'll have to read into some analyst reports there and see what the reaction is to that. Meanwhile, the UK insurers, they looked pretty mixed. Aviva seeing some outflows over at its asset management business, but not as bad as what we saw from Legal & General. So that one up around 1%. Admiral, meanwhile, outperforming, given they are managing to push up some of their pricing on their home insurance and also motor insurance as well. So that seems to be positive. Ticking even further higher on the screen there, now up around 3%. Now, Demont, this is one of the biggest makers of hearing aids in the world, around a $10 billion company over in Copenhagen. They're upgrading their guidance this morning, and that's pushing a bunch of stocks higher in that sector, including GN Store Nord, their big peer there. So that one doing pretty well over in Copenhagen. We're going to flip over and have a look at these UK stocks following that data that Sam Unstead was discussing. Now, most of those are actually coming down into the red. So Lloyd's down 0.3%, the most exposed UK lender, of course, with yields coming slightly higher, as Anna was mentioning a moment ago. And we're just seeing land securities as well. Real estate really exposed to the higher interest rates, of course. That one down around the same amount. Now Persimmon, the big home builder stock, this one obviously very dependent on mortgage rates as well, but there is an analyst report saying that this company may actually drop out of the FTSE 100. That's according to analysts over at Numis, who say that their decline could see them drop out of the main UK index. Next, pretty much unchanged, all of those stocks gained yesterday in terms of UK retail following Marks & Spencer's surprise guidance upgrade. So some of the positivity now priced in there, and that stock pretty much unchanged, down around 0.1%. Then we're going to flip over and look at my favourite screen, the ratings changes. So we have 3 downgrades at the top. Segro, they are cut at Barclays, who say that the company has highlighted customers in terms of warehouse customers. This is a real estate firm. They are slowing their decisions on renting out warehouses in the UK due to the economy declining. That one down 1%. And Antofagasta, also in London, this is a copper miner, really dependent on the copper price coming back up. And we're not seeing that at the moment. And that one gets a downgrade over at RBC. And then in terms of another downgrade, Telefonica, oh, I can't get my words out today. Telefonica Deutschland got there in the end. Perfect. That one downgraded at JP Morgan. This stock fell off a cliff a couple of weeks ago after news that O2 is potentially losing market share over in Germany, with Vodafone coming in, a new pact there. Meanwhile, Trainline getting another one wrong. Those ones that get a new buy over at Shaw, that one is on track, according to Shaw, to beat expectations. They provided the pun, not me. Shout out to them for that one.
Joe Easton, thank you very much indeed for some of the stocks to watch, some of the movers this morning, this Wednesday morning. Let's check in on what's happening. A line crossing on the semiconductor space, the chip space coming through from Intel. We had reported on this, so they have now scrapped their deal, what was going to be a deal to take over a semiconductor maker in Israel. It's going to be a $5.4 billion acquisition. This is because Chinese regulators have not approved the deal in time for the deadline. You can have a look, of course, at the geopolitics between Washington and Beijing for maybe some of the reasons behind that. This, though, is consequential for Intel because they are in a multi-year restructuring campaign under Pat Gelsinger to try to make up for some of the losses in terms of building out some of the more sophisticated chips. They were hoping this acquisition would help them build out foundries to kind of compete, at least on some level, with the likes of TSMC. This will be a bit of setback on that basis. But in terms of how this moves the stock when the trading starts in the US session, questionable given that the stock has kind of reworked or worked through some of this on expectations that the Chinese wouldn't approve this deal. So that's the latest on Intel giving up its deal to take over this Israeli chip maker.
Yeah, there have been doubts about whether this would go through. And sticking with China themes then, Tom, Chinese shadow bank Zhongrong is reported to have said it's untrue it's suspended making payments for all its products. The firm's liquidity challenges underscore troubles in the property sector where new home prices in China dropped for a second month in the month of July. Let's bring in Bloomberg's China government and economy editor, Jill Deeses. Jill, this was just the latest in a number of negative stories surrounding China that we were covering at the beginning of the week. But what is the latest and what's unfolding at Zhongrong? What is it telling us? What does it signal about contagion in the Chinese economy?
Of course. Yeah, thanks, Anna. I think, first of all, I want to point out, I was reading through that Securities Daily report on Zhongrong, putting out the statement. I want to say it says they're suspending making payments for all of their products, though obviously we've reported that on some of their products they haven't been making these payments, right? So I think that still kind of underlines that there are some pretty serious concerns going on with, not just, this shadow banking company, but, some broader concerns within the sector and whether that means that there's contagion risks that are sort of spilling over from the property sector, as we've been reporting all week. The big concern here is that when you're looking at wealth management within China, like how many of these investment products are actually tied to the broader real estate sector, which of course, as we know, has been experiencing a tremendous amount of turmoil and crisis over the last several, months, really years. And I think that continues to be a concern going forward. So ultimately, this does still spell some financial risks within China that we're keeping a very, very close eye on at this point.
And meanwhile, Jill, we're getting downgrades in terms of the growth forecasts from the likes of JP Morgan. What's interesting is not necessarily that they're downgrading, although they have downgraded from a pretty high number at the start of this year, but they are now expecting China and the growth there to come in under and below the target that the government has set itself. What is the outlook now as we weigh up the leverage in this economy and the risks around property and the financial sector?
Yes, Tom, I think that's exactly right. That concern now is shifting to this idea that China could undershoot its growth target. I mean, if you look at the JP Morgan downgrade, for example, they're looking at 4.8% growth for 2023. This is an investment bank that was saying 6.4% growth was what they were expecting out of China in 2023 just months ago. So this does, I think, have some some implications for if this recovery does not get back on track, if supportive measures don't come through that are able to address these underlying issues with demand and confidence in the economy, if some of these issues within the property sector aren't resolved, does that ultimately spell some serious trouble for the growth outlook for the Chinese economy going forward? That's, I think, you're starting to see more of that conversation bubble up now around some of these points.
Okay, and the reporting from Jill Deeses and the team on the ground in Hong Kong and China is essential reading right now as we monitor this economy. Thank you, Jill, of course, for the latest on what is happening in China. Stay with us for more. We're going to get more analysis, more market analysis on this inflation data out of the UK and, of course, the next steps for the Fed ahead of those FOMC minutes. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Right now, inflation is coming down. We've made some progress, some good progress. I feel good about that. It's still too high. The good news is the labor market has remained very strong, but it's a little bit of a double-edged sword because the question in my mind is, have we done enough to actually get inflation all the way back down to our 2% mark, or do we have to do more?
Okay, that was Minneapolis Fed President Neil Kashkari speaking yesterday about the US inflation fright, indicating the battle is not over yet. And talking about a double-edged sword, let's bring in now for more takes on this. Haig Bathgate, head of investments at Atomus Investments, on the macro picture, on these central banks and how to position in this environment. Haig, thanks for joining us in the studio. Let's start with that double-edged sword then. We saw the retail sales data coming out of the US. We talked about how strong that was. Does this add to the consensus view, well, somewhat the consensus view, that we're going to get a soft landing in the US, or does it sharpen the claws of the hawks in the Fed?
Yeah, well, I think the position in the US is very different to what we're seeing in the UK. You've seen a much more normal trajectory in terms of the way that the rate cycle's been working. Obviously, what the Fed are acutely aware of is they don't want wage inflation spiraling into this sort of second-order effect and feeding through to consumption. But I think we're starting to see tentative signs that we are very close to terminal rates in the US, and certainly we can see again compared to the UK that the rate expectations in the yield curve are substantially below what we're seeing in the UK, for example, at the moment.
And so what are you focused on when it comes to the US story right now, Haig? Is it around the inflation fight and rates staying higher for longer? Or is it around the disinflation impulse continuing? Or is there a resurgence in inflation? Where's your focus?
Yes, I think it's all about peak rates because ultimately that's the thing that's going to feed into the markets. Obviously, the US stock market is much longer duration, much higher tech component, and that's obviously why we've seen large cap tech performing very well, but we haven't really seen it until a few weeks ago, and obviously that's retrenched now. We haven't seen it feed through to a broader range of smaller tech. So I think that's what everybody's focused on at the moment. Do we see it pull back? What does that do to treasury yields? And how does that feed into long duration assets like tech companies?
Does that call on peak rates from the Fed then pull you into other sectors in the US? Are you attracted by some of the valuation propositions beyond tech?
Yeah, so I think the good thing about the US is if you're positive in the rate cycle and you think rates are going to start falling, you do have the long duration assets in the US. Coming from the UK as well, if you get it wrong and it goes the other way, it's still the reserve currency, and I don't believe that the dollar's dead. And I think if you do see some sort of pullback, and of course, what we have to be careful of at the moment with rates rising, particularly in the UK at quite alarming rates, is it doesn't trigger some sort of black swan event. You know, if we do see default rates pick up, watching the financial companies' results in particular, if we do see defaults pick up, you can get unexpected things happening when we move into an environment that we haven't seen for 20 plus years.
Yes, if we see something break, where will it break is a question that we ask a lot of people and we spend a lot of time thinking about. Let me ask you about the UK, because we got the CPI print out this morning, and as we were talking with our colleague Sam earlier, there was kind of something in it for everybody, because after the big repricing we saw yesterday on the wage data, the CPI print, it did show that big drop as expected, but it was a bit hotter than expected. How are you interpreting the UK story?
Yeah, so still of the view that some of the rate increases that we're seeing at the moment are policy errors. Rate increases have a latent impact.
So do you think the ones we've seen already are policy errors?
Yeah, I think they're errors, and obviously the market is now predicting further tightening. We see that through the yield curve. Obviously it tightens anyway. Dynamics of the UK mortgage market particularly sensitive around the 2-year mark, because we've got 2-year discounted variable rate, 2-year fixed rate mortgages are the majority of mortgages in the UK. We're just starting to see that feed through at the moment. 80% of mortgages will be coming up for renewal in the next 18 months. So you see the immediate impact of wage inflation coming through, but the rate increases have basically occurred on a latent basis.
Hey, let's get your views on China then, because counterintuitive for money is your positive call on Chinese equities. Where are you seeing the value there? What is the rationale for wanting to add exposure to China?
Yeah, well, we were just discussing before we came on air. What we're seeing in China is we're seeing actually underlying companies performing generally better than expectations, even though the economic data is poor. But the market is acting on a uniform basis to macro level data at the moment.
So you wouldn't buy the index, you'd buy individual companies?
Yeah, I think there's pockets of value in China at the moment. Chinese companies very adaptable, and of course what we're seeing in China is very different to what we're seeing here. We're actually seeing problems with deflation in China, which is kind of counterintuitive, because they didn't give the sugar rush stimulus in lockdown that we are having to unwind now. So on a relative value basis, China looks great. It's very underrepresented in global market indices and in ETFs and so on. And again, usually the best time to invest is when you see the fundamentals in companies not being rewarded through share price.
Okay, so you say underrepresented in global sort of baskets, but at the same time it is represented to some extent. I mean, we saw this story yesterday about BlackRock and other fund managers are bracing for tighter oversight following a congressional probe that is basically looking at their ownership of some Chinese companies. Now, maybe taking a company by company approach is the answer then, because this is specifically about those that are in the eyes of American authorities, national security threats. But are you concerned that this could provide another leg down for Chinese stocks?
Yeah, I mean, that is clearly the risk, and I think that's the reason why we haven't seen Chinese companies in aggregate moving up on the back of good news. We just see them continually reacting to bad macro data. But again, that presents the opportunity. I mean, of course, if we get further tightening and if there's further sort of sanction type arrangements put in place for Chinese companies, then all bets are off, but that is more than priced into to share prices in China now, I would say.
Okay, Haig, really nice to speak to you. Good to talk this morning. Haig Bathgate, Head of Investments at Atomos Investments. Coming up on the programme, Norway Sovereign Wealth Fund returns over $140 billion in the first half, indicating it's back on track following one of the worst years in its history. It has a lot to do with US big tech, picking up on our last conversation. More on that story next. This is Bloomberg.
young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
Could face bigger challenges.
Someone's next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
This is Markets Today, 24 minutes into our trading session here in Europe for this Wednesday. And you can see a fairly flat picture actually coming through after earlier weakness on European stocks. US futures look flat to positive now. NASDAQ futures actually up by 0.2%. Now, Norway's $1.4 trillion sovereign wealth fund returned 10% in the first half of this year after one of its worst years in history. The bank is the world's biggest owner of publicly traded stocks and holds over 9,000 companies in its portfolio. For more, let's bring in Bloomberg's Oslo Bureau Chief, Stephen Trelaw, who can give us details here. And clearly this is a business, this is an investor that looms huge, looms large over many markets. What drove the returns then in the first half?
So returns were driven by a 40% jump in the equity portfolio, and technology stocks were particularly strong in that sector. They delivered a return of just under 40% after a poor year in 2022. So they're benefiting from a strong demand for AI solutions and semiconductor makers. So we're seeing that feed through now. And of course, their largest holdings are in Apple, for example, and Amazon and Microsoft. So they're really benefiting from this push into technology stocks that we've seen so far this year. On the downside, we saw bonds fairly weak for the half, only up 2%, and real estate and unlisted renewable energy infrastructure were both poor performers.
Yeah, and yet they would have performed better, wouldn't they, if they just bought the benchmark? Why do they underperform the benchmark? What were some of the other wrinkles in the mix, Stephen?
Well, stocks outperformed there, which makes up the large part of their portfolio. But it was unlisted property and the renewable energy infrastructure which really pulled them down. They're performing below expectations at the moment, given that the market is having a bit of a pullback. It's a fairly small part of their portfolio, but it's feeding through pretty strongly, as we can see. As they get more and more money from the oil and gas riches of Norway's North Sea, we should expect to see more investments in this area, and maybe that might see a good time to invest in there when the returns start to improve.
Okay, Oslo Bureau Chief Stephen Trelaw, thank you very much indeed. Interested to see the CEO, the head of that bank, speaking to the Financial Times and critiquing the UK government's apparent, what looks like at least, wallback from some of its green targets. And later in the day, Norges Bank Investment Management CEO Nicolai Tangen will be joining Bloomberg TV for an interview at 1:15 UK time, so do tune in for that.
Coming up, we will take a deep dive into a really fascinating story as it unfolds in UK banking. Some British Muslims have told Bloomberg their bank accounts have been unexpectedly closed. We will bring you more on this debanking controversy, the theme, of course, highlighted recently prominently by Nigel Farage. We'll get into a different angle on this story, though. That's next. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Asian equities retreat for a fourth day on more concerns over China's economy. Strong U.S. retail sales add doubt that the Fed's inflation fight is finished. UK inflation falls, but by less than expected as the cost of travel and holidays climbs. Traders hold Bank of England bets steady. Plus, Intel's deal to buy Tower Semiconductor crumbles after failing to get regulatory approval in time, dealing a blow to the tech giant's ambitions. Tom, so the Asia session was weaker, very much to do with yesterday's story. A little bit of China weakness around China themes as well. But that was all US retail sales, higher yields. Today looks a little bit different on the yield dynamic and therefore perhaps for stocks.
Yeah, the good news is bad news theme rattled the US markets yesterday. Today, there's been a bit of a turnaround for European equities as we look at the first 30 minutes, of course, of the trading session. You're now flat across the benchmark after the losses at the start. The FTSE 100, even the FTSE 100 is flat, well, down about 0.1%, just knocking 6 points off at 7,383. What's the next level for the FTSE 100? Does it hold above that 7,300 line? Over in Germany, the DAX is off by 7 points, flat as well. Interesting, of course, given the components and the linkages between the German exchange, the companies there, and exposure to China. A reminder of the weakness of China's property sector, of course, falling sales for a second straight month. Yes, the PBOC came through with more liquidity, and yes, they came through with a stronger fix to try and support the yuan, but of course, concerns are front and center in terms of that health of that economy. JP Morgan, for example, downgrading its forecasts for growth out of China to around 4.8%, below the official figure by the end of the year. The inflation data out of the UK, of course, the BOE expectations, still traders pricing in 3 additional hikes. You had the wage data coming through yesterday, and then the CPI print core coming in slightly higher than expected. So the challenge remains, of course, for the UK on the inflation front. Let's switch it over and see how things are shaping up across these sectors. It was retail that was the only sector in the green on a day of losses yesterday, and retail posting additional gains today. Some of the earnings have come in more positive than some of the forecasts. You had an upgrade, for example, in terms of the forecast coming through from Carlsberg, though that stock is actually down after the gains that we saw yesterday before the close of trade. Retail currently, as a sector, though, holding on to gains of 0.5%. Basic resources actually turned around, a bit lackluster at the start of the session on concerns around China. Now a gain of about 0.1%. Energy is flat. You're unchanged on food. Travel and leisure down 0.5%. And utilities, bit of a safe haven play, just gaining 0.1%. Autos up 0.2. That's the shakeout across these sectors 30 minutes into Wednesday's trading session, Hannah.
Okay, so yeah, Tom, retail, sorry, the best performing sector, which is of interest to us then. Pretty split, half 50-50, half the sector's going higher, half lower. We'll watch that session as it develops. Sort of in limbo right now with US futures a little positive but not moving anywhere in a hurry. Now let's turn to a different story around financial services in the UK. The debate over debanking, as it's become known in the UK, has put fresh focus on those who have difficulty accessing financial services. Figures from the Financial Conduct Authority, the FCA, show 1 in 10 British Muslims, for example, don't have a bank account. For a deep dive into this story, let's bring in Bloomberg's fintech reporter Aisha Ghani, who has been researching this subject. Aisha, good morning to you. So, of course, this subject has had a lot of airtime because Nigel Farage focused in on it for his specific case and for the reasons that were behind his dealings with Coutts and NatWest. But you've been looking at the broader story, I suppose, here and taking a different dive into it. So what actually happens when somebody is debanked, as the phrase goes? How widespread is it?
Right, Anna. So with the people I've been speaking with, they have experienced their bank accounts being frozen, and it could be for a few days or a few weeks. And then what typically happens is that they're unable to access their money, and it means that their direct debits will bounce and they can't pay their bills. And that was what happened with Akil Ahmed from Luton, who's a former postman. And he was unable to access his bank account for 6 weeks. And then when it was reopened, when he showed his ID in branch, it was then closed again after 2 months. And his wife's joint account was shut down, and also the savers account for his kids.
Wow, and if you think about, in a very digital economy, how much that means you can't do as a result of a lack of access to your banking facilities.
This is far more of a scandal, quite frankly, than Nigel Farage, who was not debanked. He had a bank account at NatWest.
Well, he was offered one, wasn't he?
He was
said that was a late
offered
offer,
one.
so, yeah.
So this is far more consequential. Why is it impacting the Muslim community in particular?
Absolutely. So we know that Muslims are less likely to have bank accounts. We also know that they are more likely to be impacted by poverty, and particularly in a cost of living crisis, it's quite difficult to get around without a bank account in modern Britain. I spoke to one man who 2 days ago lost his Barclays account, and it meant that he had to walk 4 miles because he couldn't catch a bus, he couldn't take the tube or get an Uber. And we're talking about people who are on a less socioeconomic spectrum in this country, and it just compounds them in multiple ways.
Okay, and how have banks responded? Because, you know, they have responded around the Nigel Farage case. I imagine that there are various angles and sort of threads to the debanking story, and they all require different kinds of analysis. But what have the banks been saying?
Indeed. Well, it was earnings season recently, and most of the bank chiefs told us that they don't close down accounts, they don't take personal or political beliefs when they close down accounts. But we know that the FCA has requested an investigation and will be asking banks how many people have been debanked and why, and that will be coming next month.
So important data we can get from that particular investigation then, perhaps. Aisha, thank you very much. Bloomberg's Aisha Ghani with that, the latest on that developing story. Let's check in on the markets then, the individual stocks that are on the move. Joe Easton has a briefing. Joe.
So Admiral is the best performing stock in the UK today after the motor insurer reported some strong pricing, managing to push up their premiums and not seeing a decline in subscribers according to their insurance business. Marks and Spencer's gaining for a second day, up around 12% in the past 2 sessions now. Deutsche Bank upgrading their price target following that strong earnings guidance from the UK retailer yesterday related to their food business. Meanwhile, over in Denmark, Demont having a good session. This is the maker of hearing aids. They've upgraded their guidance as well. We've also thrown in Alcon. This company does contact lenses and also glasses. So as the producer points out, we've covered eyes and ears today, so we thought we'd get that one in there as well. Then we're going to flip over and look at the losers, the red screen. So Stellantis, the Italians were on holiday yesterday, and there is a threat of a strike in the US hitting firms like Stellantis, the owner of Peugeot, also General Motors as well. All those stocks in the US have been falling, and we're seeing Stellantis reacting as that market reopens this morning. Then I've brought up our old friend UBS. Now, there's an interesting note out from Citi today, quashing any hopes that they could spin off the Credit Suisse unit. They say they've had inquiries from investors over whether that could happen, but they say it wouldn't be politically viable, and they are quashing hopes on that one. That one down around 0.3% in Zurich. Then NKT. This is an electro components company cutting their guidance, the worst performer over in Denmark today, falling more than Carlsberg. Now, the reason Carlsberg is down, even though we had most of this earnings report yesterday, is that the volume decline is much worse than analysts had predicted. However, the CEO spoke to Bloomberg today, and he said he's much more focused on revenue than volumes. Have a listen to what he had to say.
Yeah, what we have done over the last half year is indeed to raise the prices in line with the cost inflation we encountered. We have done that across our territories, but especially, of course, in Europe. And hence you see a net revenue per hectoliter, which is roughly 10% higher than before. And by that we have been able to ensure that we would remain to have the gross profit that we needed in order to further develop our business and also to invest further in our brands.
That was the Carlsberg CEO there speaking to Bloomberg. As I say, that stock down around 2.5% over in Copenhagen, removing all of the gain that we saw yesterday as they pre-released their earnings guidance, up their guidance. But as I say, the volumes weaker than expected hitting Carlsberg today.
Yeah, volume growth of just 1% versus the estimates of, I think, a little over 1.2%. Joe Easton, thank you very much indeed, of course, from our equities team. Now, coming up, Intel's deal to buy Tower Semiconductor, well, that crumbles after it failed to get regulatory approval in time from Beijing, the geopolitics and the consequences for a struggling Intel. We bring you the details next. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
His business historically has been driven by men. Today, 56% of our customers are actually women on our website and our stores. They represent less than 30% of our business. So that's a massive opportunity for us. And I think as we get to her, understand her better, develop the right products for her, present the products in a way that resonates with her, which may not be the same way as for men, that's a big opportunity for us.
Ralph Lauren's CEO, Patrice Louvet, there, speaking to Bloomberg's Francine Lakwa, and you can watch the full interview with Ralph Lauren's CEO tonight. That's at 9:30 p.m. New York time, and in Europe tomorrow at 6:30 p.m. London time. A breaking head for you now, a red head across the Bloomberg terminal. China asking some funds to avoid net equity sales as markets sink. For some, this will smack of desperation from China's policymakers. They are asking funds to avoid net equity sales. We had the reporting yesterday, reports that they were considering a cut to stamp duty on stock sales as well. In the session today, the benchmark CSI 300 fell 0.7%, with all the concerns about deflation, about soft export sales, about, of course, the real estate market, and a reminder today of property prices falling for a second straight month, and that weighed on equities. This the next step from policymakers trying to shore up these stock markets.
Yeah, absolutely. After we saw the PBOC trying to do their bit yesterday in terms of lower interest rates, which many have expressed the view didn't do much to shore up expectations for that economy. Let us get to some of the other top stories that are being well read on the Bloomberg terminal this morning then, Tom. The philanthropic organisation that controls most of the $25 billion in assets in George Soros's family office is set to end most of its operations in the European Union. As part of a retrenchment under new leadership, the Open Society Foundation told Bloomberg it's introducing a new operating model. The changes also come as the foundation cuts headcount by some 40%. The Vietnamese EV maker VinFast soared in its first day of trading in New York after going public in a SPAC deal. Shares gained 255%, giving VinFast a bigger market cap than GM, Ford, and BMW, or BMW, sorry. However, just 1.3 million shares are available for trading, with most locked up by the company's founder and his family. European natural gas futures spiked yesterday for the second time in less than a week. They were also up a little in early trade this morning. That's as tensions run high over the possibility of strikes in Australia that could severely tighten the global market for liquefied natural gas. Discussions between union officials and one of the two companies operating the affected facilities yielded no firm outcome to the labour disputes. BlackRock is among companies bracing for tighter oversight in the United States following a congressional inquiry into investments in Chinese companies deemed to be national security threats. The Biden administration signed an executive order last week limiting U.S. investments in China in key technology industries. Vanguard, Fidelity, and DWS also manage funds with investments in China, some of which are the type that Congress is investigating. They're one example, Tom, of the tensions geopolitically between the U.S. and China in that executive order from the Biden administration, but I know we're dealing with another this morning. Yeah, well, talking of those geopolitical tensions, there is potentially, we don't know for sure, an overlay here in terms of the scrapping of this deal by Intel to buy Tower Semiconductor, which is an Israeli company, that dropping close to 9% after Intel terminates that deal because they did not get approval from Chinese regulators in time for that deal. The deadline was the 15th US time. So they've terminated that deal, Intel, and Tower Semiconductor, which has part of its business is around foundries, that is dropping around 9% on the back of that news. It would have been a $5.4 billion deal, and it was seen as important for Intel as it tries to switch focus to some of those more high-tech stocks and build out their own foundry business. So that is the move there from Tower Semiconductor. We keep across that story for you, of course, throughout the day. Back to the consumer in the US now. Home Depot earnings beating estimates, suggesting US house improvement spending is actually performing slightly better than expected. Bloomberg's Simone Foxman, she has the details.
Strong retail sales numbers, up 0.7% in July, as well as better than expected earnings for Home Depot kick off a busy week of retail big box earnings. They weren't as weak as most analysts anticipated, with comp store sales falling only 2% and revenue up at $42.9 billion. CEO Ted Decker pointing to some weakness in really big expenditures, those big ticket $1,000 plus items like appliances, like patio furniture. But it's important to note that the Home Depot consumer is a little bit different than other consumers in the U.S. economy. They're top consumer is homeowners. They're also very exposed to the pro market, so contractors in there buying supplies for new homes. And in some ways, a little bit more reflective of the housing market than overall shopping. But we'll get a better gauge of that when we get Target earnings. And then later in the week, we are looking forward to earnings from Walmart, which is trading near record highs as it's been able to capture a wide swath of the consumer base. In New York, I'm Simone Foxman for Bloomberg News.
Let's talk about what's happening in global markets this morning. Simon White joins us from our Markets Live team. And Simon, let's go first to what's going on in gilt markets, shall we? Because we started the program an hour and 48 minutes ago with the latest on the CPI numbers coming out of the UK. And it's interesting it seemed as if the gilt trade took a while to settle down this morning. We've got slightly higher yields, but I guess the market responded and jumped on the wage data of yesterday, so there was less to play with today. How did you interpret the CPI print we got this morning?
Yeah, I mean, well, obviously we expected a drop, which we got because of the energy price cap. I mean, I always emphasize the fact that inflation is a very lagging indicator, so it's telling us that something that's already happened. But the Bank of England obviously still pays attention to it, and that's why it's still important from, a market's perspective. So we were, it came in slightly higher than expected, and obviously leaves the Bank of England in a bit of a bind because the growth data isn't as bad as perhaps people expected, but there's still pockets of concern in the UK. I mean, insolvencies are near a 15-year high. Leading indicators for the housing market are very poor. So despite the sort of optically better than expected growth numbers, which still aren't great, they're just better than expected, it still doesn't leave the UK in a particularly great place. And on top of that, you have the inflation. And so that's going to keep the Bank of England tightening for now. But I think the risk is that they ultimately do tighten too much.
Okay, so that's the risk. Do you think, Simon, they go 50 basis points at the next meeting with a surprise, big number, big rate increase to kind of lock this in and tidy away the inflation picture?
I think on balance, they probably won't. The market's priced in maybe a 20-30% chance of it happening. I think they did a surprise or a 50 not that long ago. I think the balance of risks is changing. And remember, by the way, the Fed is clearly very close to the end of its hiking cycle for now anyway. And that really makes other central banks' jobs a little easier. So I think on balance, they probably won't. But as the Bank of England, so quite honest with you, I don't actually know.
So all things, various outcomes could occur. But let me ask you about what's going on in treasuries and broader sentiments, I suppose, on markets, the link between treasuries and stocks. The story of April does seem to have been dominated by weakness in stocks, weakness in risk assets on the back of concerns about higher yields. Today, we see something different. I mean, risk appetite really turned around in the last hour or so. US futures ticking higher, NASDAQ futures up 0.3%, and we see yields coming down. Where are you positioned on how that story develops, Simon?
Yeah, I mean, look, in the short term, bonds are oversold, so you'd expect some sort of comeback. We saw a little bit of that yesterday. But the genie's out the bottle, really. I mean, the market is now concerned about supply risks, and supply risks ultimately mean inflation risks. And in a much longer term perspective, if you have persistently big fiscal deficits, which now look to be a feature rather than a bug, not just in the US, by the way, but in across the Western world, the pandemic really just accelerated that. In a world of large fiscal deficits, then inflation is a longer term risk, and it tilts the whole balance. Clearly the long-term bull market in bonds, which began in the early 80s, is now clearly over. The situation is very different now. The inflation genie is out of the bottle, and governments are going to have to borrow and are needing to borrow much more than they had done in the past.
Okay, Simon, thanks very much. Simon White from our Markets Live team. Remember, you can get up-to-date analysis and insight from Simon and the rest of the Markets Live team. Mark, of course, running that team. MLIV Go is the function on your Bloomberg terminal. Now, in just a few minutes' time, we'll be talking to Gareth Davies, Exchequer Secretary to the UK Treasury, about the latest stickier-than-expected inflation numbers. They are coming down, but still work to do. Wage growth and the outlook for the UK economy also in focus. Stay with us. This is Bloomberg.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome back. Intel's acquisition of Tower Semiconductor has fallen apart after it failed to obtain regulatory approval before a midnight deadline in California. Joining us for the details out of Hong Kong is Debbie Wu, who leads our North Asia tech team. Debbie, why did this deal fail to go through? Is it all about geopolitics?
It is very much so. So Intel says that it is terminating the acquisition deal because it failed to get the regulatory approval. So that means Beijing has not signed off on the deal before the deadline for the transaction ended at midnight California time earlier today.
Okay, and there could be a geopolitical angle to that then. What does this mean for Intel's future, Debbie?
Intel's CEO Pat Gelsinger has been trying to bring Intel to enter the foundry business and compete with Taiwan Semiconductor Manufacturing Company and then Samsung Electronics to better to sort of grow a revenue stream for the U.S. company. But due to the failure to acquire Tower Semiconductor, this could sort of become more challenging for Intel to get into the market. So we'll have to wait and see whether Intel comes up with a new strategy to better compete with TSMC and Samsung on the foundry front.
Debbie, thanks so much. Debbie Wu in Hong Kong with the latest on that chip deal that was and doesn't look as if it will be. That is it for Markets Today. You can catch insights from us, of course, and the Markets Today team by going to the front page of the Bloomberg UK website or typing TLIV Go into the Bloomberg terminal. Just quick check on the markets. We're actually a little more positive, Tom, than we thought we'd be. The FTSE 100 underperforms. Other European equity markets edge higher. US futures higher. NASDAQ futures up by 0.3%. Yesterday was derailed from a stocks perspective by the retail sales print. Today we've got yields falling. Does that add some room for stock markets to go higher? It seems to be the short-term dynamic at least. The Pulse is coming up next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manish Kranny in Dubai. What's coming up on today's program? Well, Chinese authorities have asked some investment funds to avoid being net sellers of equities as the right deepens in the country's financial markets. More weak data from China pulls Asian stocks lower for a fourth session. UK inflation remained higher than expected last month, with climbing costs for travel and holidays. Investors now bet on further rate hikes from the Bank of England. And Neil Kashkari says the Fed is a long way from cutting rates as US retail sales show consumers are alive and kicking. A very good morning to you. Good afternoon if you're tuning in from Asia. This is The Spectrum. Europe is suffering immunity from the China angst and woes. Look at that. The European map is still just eking out some gains. I can tell you this. Volumes are 33% below where they are normally at this time of year, as we see growth outlook for China being slashed by JP Morgan to 4.2% next year. Immunity at the moment. I had Jane Foley with me this morning talking about a lower euro on the back of the exposure. The exposure is Europe to China, not US to China. And our headline is, of course, there's more angst in shadow banking. The authorities now ask China to some funds to hold back on their equity sales. This state of play, natural gas is ramping higher in Europe. Market jitters really about Australia. Australia, 10% of the liquefied natural gas market is in Australia. We've got walkouts and we have people on strike down there. So we saw the market explode higher by some 15%. We've come back now and dropped. Wheat is on the up. We put that in there for you, up 0.8%. There's been attacks on the Danube overnight, again in the Odessa region. So there are concerns about supply there. Now, 10-year yields are falling. We'll get to Valerie Teitel in just a moment. Now is the time, according to Stephen Major at HSBC, who says, go up that curve. Get yourself long those bonds. 30-year paper, by the way, for example, above the level that we saw in 2011. You're looking at this year's highs on 10-year paper, but we are trickling back down. And cable trades at 127.41, up 0.2%. I would say a fairly muted reaction to an inflationary narrative, which some would say is stuck and perhaps even in a spiral. We have the worst inflation in G7, CPI 6.8%, and that is something to be concerned about. Let's focus in on 10-year paper, 30-year bonds. They rose to the highest level since October yesterday. We had those stronger than anticipated retail sales for July. That reinforces the narrative that the Fed may have to raise rates further. Valerie Teitel is with us. So, Valerie, we saw this spike and now roll on some of these yields. The narrative is the Fed may still have more to go, according to Kashkari. But there is also the narrative building by some of the major houses, Stephen Major being one of them. Now is the time to enter the valley of duration. Good morning.
Good morning, Manus. Yes, a lot going on in the Treasury market. My eye is surely squarely on where these real yields are going. It really was that retail sales beat that drove a lot of the move yesterday, because retail sales, Manus, feeds directly into GDP. That control group feeds directly into GDP. Consumers make up 2/3 of GDP spending in the U.S., which is just boding ever well for this third quarter GDP print. We saw JP Morgan seeing upside risks already to their third quarter call, and the Atlanta Fed now, their GDP forecast for the third quarter is now on a 5 handle. So this U.S. economy isn't turning, I guess, negatively anytime soon. That's what the data told us yesterday. And back to Stephen Major's point on maybe now is the time to go long the bond market. I would say the I guess, opposing argument to him is, if the U.S. does enter a recession, if we do get this growth slowdown, normally what comes alongside that is a surge in government spending and a surge in Treasury supply. If you do think that this latest real yield move has been more driven by supply and demand dynamics more than anything else, perhaps actually we could enter a recession and see yields not fall as much. Yes, they would rally in the front end if we price in Fed hikes, but if more government spending is on the cards, if a bigger and swelling deficit from the U.S. government is in the cards, that could keep the longer rates, longer yields in the Treasury yield curve quite supported.
Okay, well, two sides to a market. And Major's note this morning, of course, talks about making the case for the man of straw. Valerie, thank you very much. Valerie Taital. So we've had more data from the United Kingdom. The annual inflation rate fell last month, but less than expected, as the cost of travel and holidays climbed. The latest figures add to the case that the Bank of England may have to raise rates again. But some Treasury advisors are concerned that the Bank of England is at risk of overdoing it and pushing the UK into an unnecessary recession. Let's speak to the government minister now. Gareth Davies joins me now, the Exchequer Secretary to the UK Treasury. Gareth, thank you so much for joining us. I mean, if we look at the last 24 hours, wages growth blows out by a record amount. You're looking at services inflation, the highest since 1992. Are we losing control of the inflation narrative? Are we in some kind of a doom, sticky loop on inflation? Good morning.
Well, good morning. Thank you very much for having me. Today's figures, as you were reporting, for inflation has come down significantly. I think that'll be met with some relief by a lot of families and businesses across the country. We've seen a significant reduction. I think it's the lowest level of headline inflation since February last year. But as you allude to, we're not out of the woods yet. We've got a long way to go, and we've got to stick with the plan. I think inflation reached nearly 11% last year, and while it's come down significantly from that point, it's really incumbent on the Treasury, on this government, to stick with the plan, to make sure that we're making responsible public finance decisions, and that we make sure that fiscal policies aligned with monetary policy at our independent Bank of England will continue to do that, and we're certainly not complacent despite the significant reduction announced today.
Look, yes, it has dropped. There's no doubt about it. But you have the worst inflation in the G7. The Office of Budget Responsibility says that you're in a very tricky footing at the moment. Is this government prepared to go further and cut services, cut costs? I mean, the OBR says you're going to need to do tax rises and cuts equivalent to 4.4% of GDP. Is there a political palatability to do that to tame inflation?
We've got a plan that includes ensuring that inflation is our #1 target, in terms of priority for the Prime Minister, getting that down by a half this year. Most of the forecasters believe that we will see that happen. The IMF, OBR and Bank of England all expect inflation to come down significantly this year. You talk about other countries, it is a global phenomenon driven by post-pandemic situations on supply chains and, of course, the war in Ukraine. So we're not alone in having high inflation. it is coming down. We need to stick with that plan. One of the things that we can do is ensure that our fiscal policy is aligned with the Bank of England's monetary policy. That means taking tough decisions when it comes to public sector pay, for example. We've taken action to hold down energy prices. We've frozen fuel duty. So we are taking what the IMF have called decisive action. We just need to keep going with that, and we'll see inflation come down overall.
Andrew Bailey, you talk about alignment between monetary policy and fiscal policy. Andrew Bailey has made it clear that higher inflation, or inflation spiral, as it would appear that we are in, is going to mean higher rates from the Monetary Policy Committee. Are you concerned that higher rates could invoke a pretty hard landing, a recession?
Well, nobody wants a recession. We've been very clear that critical to ensuring that we can grow our economy and avoid a recession is to get inflation down. And the Bank of England have been clear that in a year's time, if we stick with the plan, inflation will be around 3% while avoiding a recession. We've seen a major upgrade to our growth forecasts by the IMF, OBR and the Bank of England. You know, I remember not so long ago, a lot of the forecasters were saying that we would enter a recession by now. That hasn't happened. But we do need to ensure that the driving factor here is getting inflation down. We do need to align fiscal policy, as I've outlined, with the Monetary Policy Committee's decision on interest
What does that
rates
actually mean? What does
right.
that actually mean in terms of aligning your fiscal policy? It's a very broad, grandiose term, if you will allow me, but it means something a lot more severe, doesn't it, Gareth?
It means the action that we've already taken, for example, the energy price guarantee, which held inflation in energy prices. The OBR said that would knock about 2% off inflation by holding the duty on fuel, for example. You know, we've seen fuel inflation start to come down. It's taking that part, the decisive action on those factors, while also not making decisions, not taking action that would exacerbate inflation. For example, by increasing borrowing and spending at unsustainable levels, by making decisions on taxation that would fuel inflation. So it's part action that the IMF have said is decisive action, while also making sure that we don't exacerbate inflation. That's what I mean by aligning the tough decisions that we've got to make in the Treasury with the tough decisions that the Bank of England are making on monetary policy.
I look at debt to GDP. Your debt servicing costs are exploding, as are other nations around the world, before you caveat that for me. But debt to GDP is over 100%, Gareth. We haven't seen that since 1961. There hasn't been much achievement in terms of reducing that. I suppose the question that we here have got to ask you is, are we in a more perilous position for the government bond market of the United Kingdom than we ever were under Liz Truss? I mean, this is a fairly brutal statistic for you to deal with. Are you concerned about a strike in owning UK government debt with these debt to GDP numbers and it's worsening?
Well, you're right to point out the level of debt that we have in this country, but it's also important to highlight what has caused that high level of debt. We had a global pandemic shock to our economy, which required the Treasury to step in with hundreds of billions of pounds of support to ensure that businesses and individuals and families could get through the worst of that crisis. And then we came out of COVID to have an energy shock caused by the first war in Europe for decades. So we've stepped in with about £94 billion of energy support for businesses and individuals as well. So it's no surprise that debt is high. What we've got to do now is get inflation down, make sure we can grow our economy, invest in our people, garner business investment to get that economy growing, so that we can get the debt down. We are not complacent by any means. You're right that other countries are facing the same dynamics, and they are because these are global factors that have caused this situation. We've just got to keep going with our plan to act responsibly when it comes to public finances and make sure that we're boosting investment wherever possible.
Gareth Davies, Exchequer Secretary to the UK Treasury, thank you for joining me this morning. Coming up on the show, Norway's sovereign wealth fund returns over $140 billion.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Norway's sovereign wealth fund has seen a 10% return of $143 billion in the first half of the year, driven by tech. The gains there indicate that the fund is back on track after one of the worst years. Its largest holdings are Apple, Microsoft, along with a number of huge tech names. Now, it chimes with Bank of America, the survey there, which found that global fund managers are now the most overweight technology since December 2021. Hannah Gooch-Peters, global equity investment analyst at Sanlam Investments, challenges that base case. Ms. Peters, good morning. So the rest of the world is long, and long can be on tech. But you have a warning on mega stock trends. You're a little bit suspicious. Can you qualify that for me?
Morning, Manus. Well, I think that when we've seen such a dramatic move in many of these names, of course, the largest names in the world, they're all trading on very expensive valuations. And I think now is the time to be cautious. I think many investors have long forgotten the pullbacks that we saw last year. Of course, names like Microsoft, like Amazon, for example, had dramatic pullbacks last year because they were all trading on exceptionally high valuations. And I think that if you are now trading on a, say, 3.5% free cash yield in this environment, I think now is the time to just be cautious and perhaps reduce those positions, which is what we've been doing.
Bill Gross was pillaring the bulls in the bond market and lambasting the bulls in the equity market. And he said, look, the premium, the equity premium is not there. Do you think that there are cracks and fissures, as it were, appearing in the yield in equities relative to bonds? Does that have any merit for you in your world? I'm just going to grab the chart for the dividend yield to bond yield. Are you with Bill on pillaring the bulls?
No, I do actually. I completely understand the argument, but I think also those investors that have been invested long-term in bonds, unfortunately, especially due to last year, haven't done particularly well in terms of returns. And I think in an environment where you've also got inflation, those real returns can be a challenge. And on a headline level, yes, the equity market does look expensive, particularly in the US. And like we said before, that's largely driven by those large cap names that are trading on those high valuations. But this is the time to look under the hood, underneath that headline level, and you'll see that because we've had such a bifurcation in returns this year, that there are actually some really, really exciting growth opportunities coming out at more reasonable valuations in those names that have lagged those large sort of headline numbers that have really driven the market. So yes, on an overall level, equities versus bonds not looking quite so appealing, but underneath the hood, underneath that headline layer, I think there's some really exciting opportunities out there.
Look, we're getting more and more. There is the equity risk premium, by the way, relative to bonds. And as you can see, that is coming back to the average level and indeed below that. Let's shift our narrative to China. I mean, we've written a great deal. Fitch may reconsider the credit rating. There's concern now. There's narratives and instructions to the asset management community, don't sell as many equities. There's concerns about shadow banking. There's concerns about retail sales, concerns about fixed asset investment, concerns, I could go on. And yet you are quite bullish. Long-term growth, 30%. New room for pipeline, 6% compound growth in cash flows, etc. You are more bullish on China than the headlines are at the moment. So what is it? When all the rest of us are fearful, you're greedy?
So I think the example you're using there, of course, is Intercontinental Hotels Group, which is a UK-listed business, but it's got, we think it's going to have about 30% of its new room exposure in China. What we've noticed in the market is that the Chinese market is about flat this year, if you look at it in dollar terms. We've seen some massive pullbacks, of course, last year exceptionally weak. There is, again, a huge difference in returns between those companies that rely on China as a growth engine, and Intercontinental Hotels Group is one of them, for example, but other examples would be something like L'Oreal or Louis Vuitton. They have China as a growth engine. They've done exceptionally well this year. So those companies that are actually listed in China, there's been a lot of weakness around there, I think, due to the sentiment. But companies that are reliant on that growth engine are actually doing really, really well this year. There is a huge difference, though, you have to be very careful with your stock selection, I think, when you're looking at China. A company like NetEase is up close to 40% this year. It's an exceptionally high-quality company looking at that growth in online, that mobile gaming, but then you've got to stay away, I believe, from real estate and from banking exposure in particular in China.
And sorry, I misrepresented that, of course. I should have qualified it and said that there are names, and you quite rightly corrected me, IHG being one of them, which has a huge China exposure. But when you see those mega macro headlines on China, do you think people, how do you think the reaction by Europe, for example, Europe's quite steady this morning on really gushing headline after headline after headline, which is fairly turgid on China. Why the immunity or impunity, if one can use that phrase at the moment, on equities to what's going on in China? Do you think positioning is light in China?
I do think positioning is light in China. I, too, was also surprised by the sort of strength in some of these names, particularly with their Chinese exposure in Europe this morning. I think that there is a lot of weight put onto where companies are listed, and that's something that we really try to ignore, to be honest with you. We're looking for where companies generate their revenues, and I think that's what's really important. And like I say, companies like L'Oreal, like Louis Vuitton, have this massive Chinese exposure, sort of 40-odd% of their revenues, and it's a real growth engine for them going forwards, but they are trading on exceptionally high valuations. They seem to be immune more so to this Chinese, to the bad news in China. They're looking through that. And I think that sort of bad macro vocabulary, if you like, can actually be a good entry point into names. I think we have to try and look past short-term news and invest in companies that have that long-term structural growth opportunity.
Hannah, thank you very much. Hannah Gooch-Peters, the Global Equity Investment Analyst over at Sanlam Investments. Norge Bank Investment Management, I should say, the CEO, Nikolai Tangen, will be joining the TV team, the Bloomberg TV team. That's 1:15 UK time, right here on Bloomberg.
Person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
From London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Yeah, what we have done over the last half year is indeed to raise the prices in line with the cost inflation we encountered. We have done that across our territories, but especially, of course, in Europe. And hence you see a net revenue per hectoliter, which is roughly 10% higher than before. And by that we have been able to ensure that we would remain to have the gross profit that we needed in order to further develop our business and also to invest further in our brands.
The Carlsberg CEO there after the brewer said consumers are still paying up.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
The markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Market markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Chinese authorities have asked some investment funds to avoid being net sellers of equities as the right deepens in the country's financial markets. More weak data from China pulls Asian stocks lower for a fourth session. European stocks fluctuate. UK inflation remained higher than expected last month, with the climbing costs for travel and holidays. Investors now bet the BOE rates are steady. And Neil Kashkari says the Fed is a long way from cutting rates as US retail sales show consumers are alive and kicking. A very good morning. Welcome to The Pulse. I'm Manus Cranny in Dubai. You've had blowout inflation numbers in the United Kingdom, and that really is something for us all to consider. Well, the Chinese shadow bank, Zhongong, has missed payments on dozens of products, indicating troubles at the embattled lender are even deeper than previously known. The firm's liquidity challenges underscore the problems in the property sector, where new home prices in China have dropped for a second month in July. Joining me now is our China government and economy editor, Jill DeCease. Jill, look, there's lots of headlines coming across here now. Talk me through the scale of the unfolding crisis around the asset management and shadow banking at the moment.
Yes, Manus. So ultimately what you really have to remember here is that this trust industry within China, this is a $3 trillion industry in China. And a lot of the concerns that are unfolding, both at this bank, which is affiliated with a much larger one, is that it's sort of creating this idea that there could be potentially some contagion risk from a lot of what we're experiencing in the property sector right now, sort of spilling over into the financial sector. So as we understand it, some of payments affiliated, or some of the investment products affiliated with these companies, these trust companies, are related to real estate. And then, as we know, real estate problems within China have been, at this point, a years-long concern, and really kind of worsening within recent weeks and months. I mean, we've been spending a lot of time on this program and other programs talking about a lot of the problems at Country Garden, one of the nation's largest developers, which is experiencing its own liquidity crunch. And then we also know that there's these continued issues playing out across the housing sector at large. We just got some pretty weak home price data out of China this morning, some very weak property investment data yesterday. So all of this kind of combines to tell us that we still have these really, really deep-seated concerns about not just the property sector, but also how it's kind of spilling over into potentially other industries, as you see here.
Now, look, I mentioned it through the show. You've got JP Morgan downgrading growth this year and next year 4.2%. Barclays also slashing their growth targets for China. How much of that is new information? What is it in these downgrades that perhaps I need to focus on more closely?
So, look, Manus, I think the important thing to remember here is that, with these downgrades, JPM going to 4.8%, Barclays going to 4.5%, we're starting to see economists consider that China might even miss what was ultimately considered a very conservative growth target that they set earlier this year. Remember, back in March, a lot of economists were even more optimistic about what the state of the economy looked like, what growth would look like through 2023. JP Morgan at one point, I think, had a growth estimate of 6.4% for this year. Now you're starting to see these banks kind of slide under what the growth target was for the government. I mean, maybe that indicates that, the government, in setting that conservative target, was trying to pace everybody this year in terms of what the extent of the scale of stimulus would look like, how all of that would unfold. But I think now we're starting to see some fears over whether, we can really hit those targets, how we have to reorient our calculus around China, and then ultimately how we have to kind of keep in check our expectations for support and further stimulus this year.
Okay, Jill, thank you very much. Jill DeCease there on the China growth downgrades. Let's turn our attention to the crypto market. According to the latest Bloomberg data, Bitcoin's 90-day vol has dropped to the lowest since 2016. It's an unusual stretch of count for the digital token. It's hovered around $29,000 throughout most of August. Let's get to Adam Back. He's the chief executive, the co-founder of Blockstream, a leading provider of blockchain technology, and famed in your world, famed in the Bitcoin world. What will rock me out of this slumber? Volatility, the lowest since 2016. There's a deafening silence. What's going to rock Bitcoin above or below the 29,000 level? Adam, good morning.
Good morning. Yeah, I mean, I guess August is a quiet month in Europe, lots of people on holiday, but yeah, I think Bitcoin tends to surprise people by, they get bored and then suddenly something dramatic happens. So I think just leave it a while and something will happen.
Well, event risk is always there, isn't it? There's a halving event to come, probably in the spring of next year. What impact will that have?
Well, I mean, it's something that there's some debate about whether it's priced in the market. Some people will say, oh, it's priced in, but I think because of the generally high volatility, other than the last month, it's quite hard to price in. And it also punctuates the 4-year halving cycle, sort of economic cycle of Bitcoin. And historically, Bitcoin's done well. Within 6 or 9 months after the halving, there's been a sort of price appreciation part of the cycle. Now, this time,
so what do you think is possible?
Well, I think it's possible that we get to a new all-time high, like 100,000 or more, even before the halving, simply for the reason that the last few years have been kind of a depressed market in general, and in the crypto market through a number of bankruptcies and DeFi failures, things like that.
Do you really think $100,000 is achievable in Bitcoin before the halving event? There's no fear that you're very resolute on that?
Yeah, I mean, actually, I infamously took a small bet with somebody on Twitter on that. It was just some conversation about whether it would happen or not, and this fellow said, well, let's bet on it. So I let him pick the price, and so we're on. Let's see if it happens.
You got skin in the game. Good man. Look, your company, you raised $125 million. You come from the mining industry, the mining sector. $125 million, do you need more money? What are you going to do with that money, briefly?
That was just the latest fundraising activity. In total, we've probably raised about 400. We've been around since 2014. So it's primarily, well, there's two parts of it. One is layer 2 Bitcoin technology, like Liquid, which is a securitization layer for Bitcoin. It's something we issue investment products on. And the other part is hosting. So we provide hosting for institutional miners. So people like Fidelity, we host all of their miners in our facilities. It's kind of like co-location for mining, people doing mining at fund level.
I mean, just on that mining narrative and the facilities they're in, do you see a continued bottleneck in terms of the infrastructure in mining? Where are we in that cycle?
Yeah, I mean, actually, that's the subject of an upcoming financial product from Blockstream. But basically, going back a couple of years, there was a shortage of miners going into the Bitcoin bull market because the price appreciated, mining profitability appreciated, and the manufacturers couldn't produce them fast enough. At this stage in the cycle, there's actually a surplus of miners and a shortage of ready-to-use hosting infrastructure. And you have to bear in mind, a lot of the Bitcoin ecosystem is underfunded, undercapitalized. So people are using leverage, which tends to exacerbate volatility as well.
Now, I said that you're famed in your own world, and of course you are. You're one of the original gangsters. I think that's what you referred to. What we're all curious to know is, obviously, Satoshi Nakamoto apparently communicated with you in 2008. Have you spoken to this fabled person recently? What do you think he or she would make of Bitcoin now? Do you think that there'd be 100,000, they'd agree with you 100,000 is on the way? Have you communicated? Have you had any communication?
No, I don't believe he's been heard from since something like 2011, and I only communicated via email at the time. So, I mean, I guess we don't know exactly how many Bitcoin Satoshi has, but it would make him, probably one of the 20th wealthiest people in the world at that kind of price.
Okay, so radio silence. Well, he knows where to catch you. You're obviously making bets on Twitter. Well done. Good to have your call this morning on the miners and indeed on the halving event and where prices will go. That's Blockstream's chief executive and co-founder, Adam back on Bloomberg. Coming up on the show, Open Society Foundations ending most of their operations in the EU. More details behind the shift in direction by George Soros' charitable organization, The Moves on Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Big tech matters. We know that. Breaking news on the pulse. I'm Manus Cranny in Dubai. Tencent has just delivered their numbers for the second quarter. Now, the revenue has missed. So the top line revenue is a miss, 149.21 billion yuan. That estimate out there was 150, just under 152. Now, the issue is this, is that on an adjusted basis, the net adjusted income is 37.5. So that actually is a beat. In the very first flush, we dropped by over 1%. So the revenue is a miss. Value-added services revenue is 74 billion. Just digging through here, they've cut their total of employees by just over 1,700 in the second quarter. They hire 104,000 people. Just think about WeChat, think about the platform, think about the network that they cover. 11% growth in revenue matches the March quarterly growth. But, you know, the top line miss is small, one could say that. We have an MLive blog for you there. Our editors and reporters are contributing throughout, dissecting the numbers from Tencent. The stock's up 3.65% year to date. Do you want to be long tech in China? That is the question. Revenue up 11% year on year, but down 1% on the quarter. We'll leave it there. The philanthropic organization that controls most of the $25 billion of the assets in George Soros' family office is set to end most of its operations in the European Union. For more on what that means, Maria Tadeo joins me now. So this is the end of a generation, really, of Soros in Europe. Is this a downsizing? Is this a statement? How do you walk away? How do you take away the walk away?
Absolutely, Manus, and this is a very significant story for many reasons. To some extent, as you say, the Soros Foundation, Open Society, they say they will terminate their operations in the European Union this year, and the operations that they keep and decide to keep will see extremely limited funding. Now, the reason for this, they argue, is a strategic change in their priorities. A positive spin they're given to this is that, to some extent, the European Union already provides the tools and the platforms for ideas like freedom of speech and democratic democratic values. So therefore, the funding from the foundation may not be needed as much, and they want to switch into other countries like perhaps Ukraine and Moldova. But Manus, you alluded to this. It is to some extent the end of a chapter here, because George Soros has a very personal and deep connection with the region, in particular with Central and Eastern Europe. Let's remember, he is Hungarian by birth. He was a big critic of communism and has been deeply engaged in the political debate in that region. So now pulling back from it, obviously, it carries a very almost sentimental impact on this region. And we see this pulling back, which they say is strategic, again, is thin on the details, but obviously politically significant too.
What are the political implications, Maria? I mean, we just had a massive graphic there, $19 billion spent, but is there a political undertone as well on this withdrawal, or scaling down? Maybe we should use the word scaling down.
Yes, yes, and already, by the way, when you talk about the downshift and the scale down, we knew that it was happening to some extent because Mr. Soros passed on control of the foundation to his son, and we knew that job cuts anyways would happen and would take place. The significance of this is that most of the operations, in theory, would cease to exist. But it is political, as you say, because this is not just any foundation, and we know that Open Society and Mr. Soros himself is a real political battleground in countries like Hungary, but also to some extent too Poland. And we know there has been now for many years a political fight between Mr. Soros and the Hungarian Prime Minister Viktor Orban, who has said that he's not doing charity, that he's not doing philanthropic work, that this is a political network that tries to decimate traditional Christian values. Of course, there has been a lot of criticism about what Viktor Orban means by those traditional Christian values. So again, is that clash of the two, particularly in his native country of Hungary. The other flip side to this, just very briefly, is that a lot of the organizations and the platforms and the civil platforms that work with open societies, what they could argue is that if they receive less cash, actually that is detrimental to the values that Mr. Soros says he has stood for his life, is that, well, obviously democracy and liberal values, if you don't have the funding, it would make it very difficult for some of these NGOs and civil platforms to continue their operations.
Okay, Maria, thank you very much. Valuable insight there into George Soros's move on funding in Europe. Maria Tadeo. European natural gas futures are lower this morning after spiking in the first flush for the second time in less than a week. That's as tensions run high over the possibility of strikes in Australia that could severely tighten the global market for liquefied natural gas. Now, the discussions between European Union officials and one of the two companies operating the affected facilities yielded no firm outcome to the labor dispute. Ukraine's energy minister says the country is preparing for another hard winter as the war with Russia grinds on. It's an exclusive conversation with Bloomberg. German Galushenko told us Kyiv is expecting more inflows of gas from its European partners.
Today, we could say that already something around 600 million of gas stored in Ukraine, which is gas of European companies. And that is also important for the security of supply in Europe, due to the level of storages in Europe now, because it's very high. So I think that is a good solution for the business, and that is a good solution for European security.
Do you expect more coming, Minister, from Europe?
Yeah, we expect more coming. So I can tell you that we expect average something around from 500 to 600 per month. So, and we could offer, so our storages, we need 15 BCM for Ukraine for the next season, and so 15 BCM is open for storing in Ukraine.
Can we talk about what you expect to happen this winter, Minister, both in terms of the situation in Ukraine and what you think the energy situation is likely to look like in Europe?
I think that's very important. I mean, when we are talking about the gas, that's very important instruments which already started in the European Union. That is the joint purchasing platform, which would allow not to speculate the prices and manipulate the prices. And I think that that is a very important decision. Concerning the Ukrainian energy system, of course, we are preparing for another hard winter. So, and I just recall you that the previous winter, we were living under everyday massive attacks on the energy infrastructure from Russia. So it started from the 10th of October, and the last massive attacks one was on the 9th of March. So, and it was every day by all kinds of weapons. So now we are preparing for the next winter, and we are not expecting that they wouldn't shell our energy system.
The Ukrainian energy minister speaking to Alex Steele and Guy Johnson on the gas flows. Coming up on the show, some British Muslims have told Bloomberg that their bank accounts have been unexpectedly closed. We bring you more on the debanking controversy right here on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are and what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Ralph Lauren CEO Patrice Louvet there speaking to Bloomberg's Francine Lacroix. And you can watch the full interview with Ralph Lauren CEO tonight, 9:30 p.m. New York time. That is on Thursday at 6:30 p.m. London time. Well, Well, ever since British politician turned pundit Nigel Farage said that the bank account of his was shut down because of his political beliefs, the issue of debanking has been thrust into the public spotlight. However, it's an issue that British Muslims have to contend with for a while. Joining me now is our fintech reporter, Aisha Ghani, who has been researching the story. Aisha, what actually happens and when do you get debanked and just how widespread is it?
Morning. So when I've spoken to people who have been impacted by having their bank accounts shut, what has typically happened is that their account will be frozen for a few days or for a few weeks. And in that time, they have been unable to access their money in their accounts. It means that their direct debits have bounced. They are unable to pay their bills. I spoke to one man, Akil Ahmed, who was a former postman in Luton, and he was frozen out of his account for 6 weeks. And in that time, he wasn't able to pay for his groceries, and then eventually the bank did shut his account down, as well as his wife's joint account and the savers accounts of his children. Now, it's pretty widespread. We know 1,000 bank accounts are shut down each day, and it has been going up and up in the last few years.
Well, I mean, obviously the Muslim community has been hit particularly hard by this debanking. Is that fact? Where are we with the data on that?
Yes, so we know that Muslims have had less of access to financial services. We also know that most Muslims, so in terms of the people who are unbanked or don't have bank accounts, 1 in 10 Muslims don't have bank accounts, so they are particularly impacted by the lack of access to financial services. Now, over the last 2 decades, when it's also compounded by post 9/11 and 7/7, as well as hostile environment policies of the UK government, it has meant that people have been impacted by many more ways, and then having a lack of financial services also compounds this.
Okay, Aisha, thank you very much. That is Aisha Ghani on the debanking in the United Kingdom. Quick snapshot of Tencent. This is the top line for you. The revenue missed, 149.2 billion. So that's sub what the estimates out there was. But there's a couple of other lines in there which, reasons to be cheerful. I'll leave you with a cheerful note, which is, of course, the net interest income is on the up on the social network. So I'll leave you with one uplifting thought.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Inflation very much in focus. The Fed's Neil Kashkari warning that he's not ready to call an end to rate hikes. Fed minutes from the last meeting drop at 2 p.m. Eastern. How many will be in Kashkari's camp? UK inflation comes in hot again. The pound jumps as holiday prices keep rising. Service sector inflation remains sticky. The news, of course, piling pressure on the Bank of England to keep raising rates. And financial giants face fresh China scrutiny. BlackRock, Allianz, Fidelity, maybe amongst key stakeholders to watch in the country garden debt crisis. This as more local wealth managers miss payments to investors. Keep an eye on that story. Welcome to Bloomberg Surveillance. This is the early edition. I'm Guy Johnson. I'm, of course, in for Danny Berger in London. Kriti Gupta very much in New York. Kriti, there's a lot to think about. This inflation narrative front and center. China not far behind.
Not far behind. I would argue interesting kind of read through into the market stateside, Guy, because you would think that if those Chinese concerns really did have a read through, you would see more of a sell-off. And we're seeing the exact opposite this morning. Green on the screen when it comes to the equity market. Futures higher by about 0.2%, 44.63 for our radio audience on those contracts. But Guy, the market really gets interesting when you look at the bond story simply because of those contradicting inflation metrics. Remember, we had Neil Kashkari, as you just pointed out, saying, well, we might not be done, while all the data kind of points at, well, maybe we might be. So, of course, we're going to kind of, everyone's going to play economist for a day, if you will. And I think the bond market is already doing that. The two-year yield coming back down to tune about 5 basis points, 489 on that note. What's interesting is that it is also dragging down the dollar. Now, some of this is coming from the UK, so we're going to talk about the counterweights in just a moment. But take a look at the Bloomberg Dollar Index, weaker at the moment by 0.2%. Again, the China read-through, not really there, even though, Guy, I should mention, we did just get 10-cent earnings just a few minutes ago. They came in weak, so perhaps yet another warning about the strength of the corporate sector in China as well. And of course, NYMEX crude trading with an 80 handle, about flat at the moment, but you can definitely see the direction of travel is down.
Bit of data out of the Eurozone, Euro area, Q2 GDP, 0.3, estimates 0.3. That's pretty much in line with estimates, as I say. What I think is interesting is take a look at the screen right now. Take a look at your Bloomberg. Look at the industrial production number. Comes in way better than anticipated. This is a theme that is developing. The industrial side of the economy seems to be gaining a little bit of traction at the moment. Keep an eye on that. Let's talk about where we are with European stocks. 456. We're basically not too far away. We continue to be not too far away from the 460 level. The markets are getting more exciting as the week progresses, definitely. They started off definitely on holiday, seem to be coming back a little bit in drips and drabs, but we are still in a very tight range. I think I would argue yesterday, negative session, we're a little bit positive this morning. The pound up, unsurprisingly, given that inflation print that we've just had out of the UK. It is coming down slowly. The problem is, though, that core is sticky, services are sticky, holidays are sticky. All of that putting pressure on the Bank of England, plus the wage number yesterday. So the pound is rising on the back of that, 127.59. Critty was mentioning Tencent. NASPA's the proxy. This is what we've got in terms of the reaction to the numbers. NASPA's is down because Tencent has missed. So that stock down by, let's call it circa 3%, Critty.
Yeah, a lot to digest in the corporate sector from China as well, but I think the UK perhaps driving the market more in the bond market and the currency market, I would argue this morning. Let's go there. The UK's annual inflation rate fell last month, but by less than expected. This comes as the cost of travel and holidays climbs. The latest figures adding to the case for the BOE to raise interest rates again. Joining us now, Bloomberg's Valerie Teitel. She is all over this data. Valerie, walk us through it.
A lot of the attention this morning was on the core number that came in a tenth stronger at 6.9%, matching the previous month estimate. And if you look at where the trajectory is for core inflation here in the UK, it really has not budged. In the last 3 months, it's only gone from 7.1% down to 6.9%. That is really not a lot to celebrate when it comes to the Bank of England. There was some good news for consumers in this print that headline CPI did fall, driven by a fall in food prices, a fall in consumer goods, which is good for the consumer. But for the Bank of England, it's bad news. We are seeing domestically generated inflation. That is the concerning bit. Very sticky. Services inflation remains sticky and is still on the rise despite the fall in headline. That is the one concerning thing. And Critty, if you look on a large scale, the thing that tempted the Bank of England to hike 50 basis points last time was a hot wage number and a hot core CPI print. We got those two today. The fact is, though, we have a long way to go until the Bank of England meets again. It's not until the 21st of September, and we do get another round of data.
The last time I listened to the governor, the last press conference, he was talking about the fact he was nearly done. We're getting ready to pause. That was the message that's been coming from a series of central banks, or at least was. The message seems to be hardening. Kashkari yesterday. It's going to be interesting to see what the minutes tell us today. I suspect the Bank of England's going to have a little bit of a rethink again. Do the markets need to have a little bit of a rethink? How much is being priced right now in terms of the idea that actually rates could be, as they've been telling us, maybe higher for longer?
Well, look, you know, the one big, I guess, vulnerability for central banks that have gotten too dovish too early is just clearly in the bond market with those real yields staying ever higher for longer. I think the U.S. is a different slight scenario, though, because if we look specifically at what's been supporting U.S. growth, it's been government spending. And what has that caused? Yep. A surge of Treasury supply. What has that caused? This surge that we've gotten recently in real yields. And the concerning thing is there, in the coming months, the trajectory for government spending, we're headed into election year. It's still going to be strong in the U.S. And then if we do get a downturn, we get all these automatic stabilizers of welfare payments. So the trajectory of real yields, to many in the market's minds, is ever higher from here. And that could cause a bit of headwind for equity markets going forward.
Certainly a lot to digest, and of course, we keep coming back to the same theme. Where is the kind of read-through coming from? Is it coming from Europe? Is it coming from China? Of course, something you're going to be monitoring very closely. Valerie Teitel, everyone, for Bloomberg News. We thank you, as always. Let's go from Europe over to China. The fate of global investors is in focus as Country Garden sits on the brink of a maiden bond default with major firms exposed to the property developers' dollar bonds. Joining us now, Bloomberg's Rebecca Chung-Wilkins. Rebecca, walk us through who might be on the hook. Who has the exposure here?
Well, some of the big names that we recognizable to a lot of folks here, BlackRock, Allianz, Fidelity, HSBC, among some of the largest firms with the biggest exposure, at least according to recent filings. Now, worth pulling out a couple of those names. Just a couple of months ago, Country Garden's bonds were trading well above 40 cents. We're now in the sort of 9 cents, 10 cents, 7 cents range. So a significant drop off there. And also worth pointing out at the levels at which these distressed bonds are being priced at. We're not just at a distressed level. Investors are not just pricing for a haircut, but for a really steep haircut. They're not at 20 cents.
And all over that story, we thank you as always. Of course, we go from China back to Europe. The world's biggest owner of publicly traded stocks, the Norway Sovereign Wealth Fund, returning 10%. It's about $143 billion in the first half of the year. The gains indicate the fund is back on track after one of its worst years. Joining us now to break it all down, Bloomberg's Jan Patrick Barnard. Jan, one of my favorite kind of fun facts about the Norwegian Sovereign Wealth Fund is that back in 2008, when he had that massive tech sell-off, everyone was kind of in the doldrums. This is a fund that really scooped up a lot of tech, a trade that would really prove quite wealthy, ultimately, for the next 10 years or so. What drove the returns this time around?
Well, it was no surprise here. Tech again, as the fund, of course, it's so large. So there are two things that they need to do. First of all, I mean, they want to be in the part of the equity market where there's the most juice, and that is still undoubtedly U.S. tech, even with the wobbles that we saw last year. So that is still a big weight for the fund. And on the other hand, given it's so big, it also needs to pick those stocks that are big in market cap, because it makes easier for the fund to handle it going in and out in those stocks, because they just simply provide more liquidity. So no surprise here that the fund is like big in U.S. tech, and that drove a major part of the performance. Again, the fund is so large that you have to spread your assets all over the place to make sure you're well diversified. But that also means, like, it has a lot of benefits, but it also means like that the chances are high that you are almost always part of something that doesn't work, and that in this case was some losses here from Silicon Valley Bank. So the fund was also involved in that one. We also saw that commercial real estate, non-listed commercial real estate, is an issue for the fund. I mean, we just heard from what's going on in China, so that's probably an issue to stay. And then renewables is also something that didn't work very, very well for the performance. Again, something that we have seen in Europe as well. If you look at the results of Siemens Energy or of Vestas, then you know what's going on there, and that's not an asset that is performing particularly well in these last couple of months.
JP, thanks very much indeed. JP Barnett joining us on what is happening with the Norwegian Wealth Fund. We're going to hear from Nicolai Tangen, the CEO of that fund. That interview is going to be on Bloomberg Surveillance. It's going to take place at 8:15 a.m. Eastern Time. Looking forward to what he has to say. A little bit more detail coming, I suspect. Coming up in this hour, though, today's UK CPI definitely fueling BOE rates hike bets. What happens next? We're going to find out. We're going to get a guide to what could be coming from the bank. Senior economist Callum Pickering joining us from Berenberg. Plus, US retail earnings in full swing. Target reporting its results in just over an hour. More ahead of that. This is Bloomberg.
Thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Well, the story is all about the bond market. Even though we are smack in the middle of the summer, you are seeing some sleepy trading, yet plenty of action. I think Guy Johnson will agree with me on this, which brings me to a chart I want to show you. For our radio audience, stick with me. It's a pretty simple one. We're looking at the 2-year yield, nothing too fancy, but it's a chart that goes all the way back to, let's call it the spring of 2022. And basically what you see is this acceleration in the yield story. We knew that, inflation ramping up. And then it kind of stayed a little bit range bound for, I want to say, the next, 18 months? Or so, but it is continually testing that 5% level. I think this is interesting as we talk about what the terminal rate might be, guys. Simply this idea that you continue to see this yield story coming, moving higher and lower, not necessarily on a change from Federal Reserve policy, but I think more from the cut story that's priced into the market. And yet here we are, again, this morning, retreating from the 5% level.
Yeah, it's a key line in the sand, isn't it? And it's a massive moment for the market once again. The narrative seems to be quite clearly, though, that the Fed is going to push back on the idea that we're going to see cuts. The market up until now has not believed the Fed when it says it's not going to deliver cuts, but the market keeps being confounded by the Fed. It actually continues to be confounded by the data as well, which keeps coming through stronger. You look at the nowcast data at the moment, it is pointing to a US economy that is miles away from a recession. Why would the Fed be cutting if we are miles away from recession? Why would the Fed be cutting if we're still in an environment where it doesn't know whether it's beaten inflation? So the market keeps projecting and thinking, yeah, you know what, normal cycle, we're going to be seeing the Fed cutting.
Yeah, and I think
the Fed just keeps pushing it back.
I think to your point, it comes back to the same question that we've been asking our guests all week. Resiliency or recovery? What does this actually look like? Because if you are looking at resiliency, if you are looking at that confidence in the market, does that just mean yields go higher and higher? And at the end of the day, when does market plumbing, and the bond market specifically, become an issue for the Federal Reserve? Essentially, at the 2-year yield, it is at the tide to that Fed policy. So if the Fed is saying, look, we're not going to cut, but the economy is doing fairly well, that's not great for people who are betting on or who are bullish on bonds moving lower.
Absolutely not. And you've got two different arguments as well. You've got the front end story about Fed cuts, plus you've got the long end kind of deficit story, this bear steepening that we've seen, which could keep rates over the longer term higher, which is something else that the market's had to deal with. So that kind of move up in the middle, in the belly, has been really significant as well. That's been certainly something to watch out for. The idea of cuts just continues to really, the market's really struggling with figuring out what it's going to look like. What kind of a curve are we going to be getting? And there's all kinds of things at the moment pointing to higher rates. And then you extrapolate that and you take that into the equity market. The equity market is not positioned for these kind of high real rates as well. That is another factor that we've got to bear in mind here. You then fold in liquidity. As that starts to ebb away, is that going to be another problem, another headwind for the equity market?
Yeah, and a lot of that has to do with simply those longer term kind of stories when you talk about those inflation expectations that you just brought up. But then you have to talk about the consumer inflation expectations as well. Ask your man on the street. They'll say, well, actually, I think inflation is going to be there for longer. Guy, we're going to digest all of this coming up shortly. We've got Callum Pickering from Berenberg Economics. We also have FOMC minutes coming up later. We're going to digest all of it. But for now, stick with us. This is Bloomberg.
names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Let's get some key news developments we're following this hour. President Biden says he plans to travel to Hawaii to see firsthand the devastation from the Maui wildfires. Biden says he's spoken to Governor Josh Green, so the trip does not interfere with the rescue work. The wildfires have killed almost 100 people, making them the deadliest in the United States in over a century. One risk modeling firm says the disaster will cost insurers more than $3 billion. Guy, this is an evolving situation. We know the death toll keeps climbing. Yep. All eyes on Washington about how they're going to handle it.
Yeah, there's been a lot of criticism as to why the president hasn't engaged with this story a little bit earlier, why he hasn't gone. You've seen this time and time again during this administration, that maybe the administration has been slow to respond to crises. You saw that with the derailment. Maybe we're now seeing that with Hawaii. I want to talk about what's happening with the union story, because this labor market narrative, I think, is so fascinating at the moment, Kriti. The leader of the United Auto Workers Union is asking members to grant him the ability to call a strike. Now, this is interesting because he's arguing that the contract talks with the big three in Detroit, the big three car makers, basically are moving too slowly. The group has been negotiating with GM, it's been negotiating with Ford and Stellantis for 30 days. The parties have yet to discuss economic terms. He wants to get on with it. He wants to accelerate the process. Now, obviously, there's a kind of mechanical process that he normally has to go through, and he's saying, you know what, we need to speed it up. We need to basically get the rubber to meet the road, and we need to get on with this.
What's interesting is he's essentially taking a page out of the Teamsters Union playbook. This idea here that you should actually be more aggressive towards these companies rather than kind of engaging in these diplomatic channels. It's something, by the way, that you're seeing even the Hollywood strikes kind of use as a way to deal with the studios as well in California and around the world. So certainly something you want to keep an eye on. We should mention, by the way, we have an open invitation to the United Auto Workers president in right now, so hopefully he will join the network soon. But Guy, in that same vein, let's talk about an industry that's actually been affected a lot by the unions. That, of course, is going to be the logistics story. An affiliate of Ken Griffin's Citadel is said to have acquired roughly $485 million in yellow debt, previously owned by Apollo and other senior lenders, to the bankrupt trucking firm. The deal comes as Yellow seeks to secure a bankruptcy loan to fund its liquidation. Now, of course, remember, for the folks who aren't actually following this, the Yellow Trucking Company goes back almost a century in terms terms of kind of really building, I think, the infrastructure of the United States. But in the last 10 years or so, it really hasn't been able to recover from the global financial crisis. And that is an important part of their bankruptcy story. Now, in recent weeks, they've actually come out and said, well, that Teamster union, which represents, I think, a good chunk of their workers, not the majority as it does with some of the other logistics firms, but a good chunk, they are actually saying, well, it's because of those union negotiations that we went bankrupt, even though we do know there is that a loan that they still have from Congress issued to them during the Trump administration. A lot of cross currents here, but Wall Street already acting on what they're seeing.
Absolutely. A lot of people I've been speaking to, this is not my opinion, this is the people I've been speaking to, believe that this company was already on the brink, that it's been teetering on the brink for a very, very long time. I think pointing fingers maybe is a little unfair at this point. But I think the bigger picture that you raised about what's happening with unions, I think is really important. There is a clear demographic shift which we are beginning to enter. You've seen labor shortages from the pandemic. That story feels to be over. We're now entering a kind of new phase. And we were talking yesterday with Jean Boivin about this, a new phase in which the demographic story is going to mean that there isn't going to be this large labor force. And in that environment, you would have thought that labor, you would have thought the unions would have significantly more power. And that, in theory, could drive higher wages.
Well, it already kind of is, and you can see that in some of the bottom lines. I mean, UPS, for example, a couple weeks ago, their stock tanked simply because of the margin pressures coming from these wage negotiations. Disney, Netflix, they are dealing with the same issue, Guy. This is something we're definitely going to be talking to our next eco guest about, no doubt.
Absolutely. I do wonder whether what the kind of the cases you raise, whether that's related more to what is happening with the pandemic rather than the kind of the demographic shift. Anyway, as you say, we'll talk about it. Callum Pickering, senior economist at Berenberg, is going to join us next. UK CPI, hot, hot, hot. We'll talk about it next. This is Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation in focus. The Fed's Neil Kashkari warning he's not ready to call an end to the rate hikes. Fed minutes from the last meeting drop at 2 p.m. Eastern today. How many will be in Kashkari's camp? And UK inflation comes in hot yet again. The pound jumping as holiday prices keep rising and service sector inflation remains fairly sticky. The news piling pressure on the Bank of England to keep raising rates. And financial giants face fresh China scrutiny. BlackRock, Allianz, and Fidelity may be among the key stakeholders to watch in Country Garden's debt crisis. This is more local wealth managers miss payments to investors. I'm Kriti Gupta in New York with Guy Johnson in London. Guy, we talk a lot about the China story, the inflationary story there, and whether or not they're actually exporting deflation. You're already seeing a pullback in their property sector, even their tech sector.
Yep.
I'm not sure that's having a read-through into the rest of the world, though.
It may not. This may be one of those stories that takes a while to come through. But in the past, for those of us that lived through and I know you read about it, those of us that lived through the devaluation, we have seen the impact that China can have on the economy. You came out of the last crisis, 2008, 2009, China powered the global recovery. It's not going to be there this time, potentially. Stock 600. I'm being told watch 453. There's a key line in the sand there on the moving averages. We're basically flat. Again, quite range bound. Within there's some individual stock stories that are worth focusing on. Pound's up quite strongly, up by 0.4%. The market seems to believe that yesterday's data and today's data, the CPI number, will encourage the Bank of England to go further. The market is now pricing 6% as the terminal rate. Tencent has missed the proxy in Europe. Naspers, big stakeholder. That's stock Kriti, down by 2.88%.
Yeah, I mean, you bring up a good point about the devaluation. And Guy, I will say I'm both older and younger than I look. We'll leave it at that here. When we look at the futures trade, though, it gets really interesting. Green on the screen at the moment, but paring back a lot of the gains we saw just 30 minutes ago in New York, 44.59 on the S&P futures, higher by 0.1%. Again, not any major conviction in either direction, but enough to say, look, maybe there is a little bit of positivity. Remember, yesterday we sold off, though, so it might just be a simple reversal of that on this light summer day. The two-year yield gets interesting as well because really it feels like the repricing is mostly coming from the bond market, not necessarily the equity market. Those real yields are going to be playing a role, especially as we talk about the read-through, not from China, but from perhaps the UK and Europe, where you are getting extremely hot inflation data. Two-year yield, 490 is where we'll call it. The yield story bringing down the dollar as well. And again, that's also going to be a function of the UK story. So that's going to be something we want to watch as well. Bloomberg Dollar Index down about 0.2%. But Guy, if we're talking about a pullback at some point or even resilience in the economy, you would think there would be more volatility in the crude market, and we're not really seeing that. NYMEX crude really testing the 80 level here, now 81, really unchanged on the day, but perhaps that's where the volatility is due to pick up.
Crude came up pretty rapidly. It now seems to be consolidating a bit. But yeah, it's a good point, and it's well made. Let's talk more about that inflation story, Kriti, and how the Fed is reading the narrative that it sees in front of it. Investors are now waiting for the Fed's latest minutes. I think they drop at 2 p.m. Eastern. What we're going to get there is a glimpse of the official thoughts on the bank policy path from the last meeting. Neil Kashkari, though, has gone from being dove to being a firm hawk. And it was interesting listening to him yesterday, very much making the case that he feels that the Fed should not be done yet.
Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
So how many will be in Kashkari's camp? It's going to be interesting to see whether it's just a minority that believe that the Fed could hold at these current levels. And what is the read across into other central banks? You look at the wage data out of the UK yesterday, you look at the CPI number out of the UK today. Callum Pickering, senior economist at Berenberg, joins us now. Do you think Kashkari's right? Do you think the Fed might have more to do? The market's anticipating that we're going to be seeing cuts soon. He's pouring cold water on that.
I wouldn't over eagerly anticipate cuts because all of the latest data from the US is consistently better than expected. There's a lot of resilience in the economy, but monetary policy is now tight in the US. By definition, that will disinflate prices over time. It's just a question of how long it takes. If you're willing to tolerate an 18-month horizon, and just accept actually we'll benefit from this stronger than expected economic data, great. If you're desperate to get inflation down quickly, you run a recession risk. I think the Fed does not want to run a recession risk, and I don't think the administration wants a recession.
So it's done enough. It can sit tight. It can wait for the real rates to work their magic, and the economy will glide to a soft landing. Can you say the same thing about the UK?
The Bank of England is still on course for a soft landing. We didn't get the recession over winter that was widely anticipated. The outlook is for an improving economy over the next 2 years, but it won't happen immediately. The Bank of England should be thinking probably one more hike and then done. Slight risk.
Market's pricing 6% terminal.
Yeah, my view is that's too high. We need to just keep in mind, central banks often make policy mistakes. They tighten too much and they ease too much. The reason why is because once the balance of evidence has shifted in favor of stopping or indeed hiking, depending on which way you want to go, they just go further. This is human nature. We have a bias problem. We know this. And so sensible policy accounts for this. It accounts for the fact that monetary policy works with a lag, which means you stop hiking well before inflation is back on target. If we hike until inflation is on target, you've gone too far by definition, you get your recession, which is the thing we need to avoid.
Callum, when we talk about the UK in international context, it feels like the narrative continues to be that inflation is stickier in the UK simply because of kind of the structural hindrances that the economy has there. Talk to us about how the wage picture plays a part.
So wages in the UK at the moment are much too high, running at the 7 to 8% range year over year. However, the setup in which wages are being bargained up does not suggest that the UK is suffering from this so-called wage price spiral. Why do I say that? Inflation expectations on consumer surveys and the Bank of England's own survey are coming down fast and are now actually slightly below the Bank of England's target on a 2 to 5 year view. If wages are high in that context, we can't conclude that wages are being bid up in anticipation of high prices in the future. That's the conditionality for a wage price spiral, because those prices then become self-fulfilling once you spend those wages. What we actually see is tight labor markets providing workers with the ability to actually fight back against these cost pressures and defend their real incomes against the losses of last year. My bet would be, with a dramatic easing of labour market tightness, and there really is a dramatic easing now in the UK. You look at the single month estimates, employment is plunging, the unemployment rate is rising fast, vacancies are coming down. I don't think there's any basis to think that these wage growth numbers will remain elevated into the next few months. And in fact, actually, I think we're going to be surprised to the downside, that wages lag inflation.
If wages do actually lag inflation, though, and you are still seeing this upward trend in even just nominal inflation in the UK, is that divergence concerning to you? And to me, that feels like there's going to be a massive dislocation then in the economy.
Yeah, I mean, we have to think about base effects, actually, when it comes to inflation. So headline inflation on the month of June declined by about 0.5 percentage point. That was due to the fall in energy prices, the prices that consumers paid due to a policy effect. The market has focused a lot on the core rate, which moved sideways at 6.9%. But if you abstract from the base effects, if you look at the last 2 monthly numbers for core, and you think about those in annual terms, actually core inflation is running at 2% for the last 2 months in the UK. That's down from north of 15% in spring. So there's been a huge drop-off in core inflation. The only thing that remains a bit of an inflationary echo is services, but that should turn down in line with wages because services have a huge wage component.
Governments are driving spending, deficits are going to be big, rates are going to stay high. We're shifting into a demographic deficit where we're going to be seeing fewer workers come in. That's going to give workers more power. All of that sounds inflationary to me. All of that sounds like we are going into a period where rates are going to stay significantly higher than they were pre-pandemic. What's wrong with that argument?
There's nothing wrong with that argument. The point that rates will stay higher is sufficient as a base case, but then the question is, what does the volatility around that look like? So I wouldn't say that inflation will be structurally higher, it just will be more prone to bouts of inflation because of this tighter balance between demand and supply. The other thing to say is that if monetary policy is set appropriately, there's no reason to have structurally high inflation. Central banks can pick their inflation rate. The big question here, the big uncertainty is...
Do you think that should change?
Say that again?
You think sorry, just to be clear, you're saying that we shouldn't have the 2% target, we should have a different target?
No, we can get to the 2% target central banks can set that. It's just, it might need a 4% base rate into the future instead of a 0% base rate. Once you set monetary policy right, you can keep inflation where you like it. But in response to these price signals, do we get more investment? And that's where I think there's a potential upside risk here, because we can see the potential technologies that can be integrated into supply chains and into businesses that help reduce unit labor costs, they help displace labor, and yet we haven't seen that dispersion over the last 10 or 15 years. The price signal now is telling us to invest. If we tighten too much and cause recessions, you don't get the investment. And so this is a finely balanced policy dilemma.
Callum, a final question to you on the U.S. here stateside. We get FOMC minutes this afternoon, 2 p.m. New York time. What are you watching for?
Neutral from the Fed. They'll stay data dependent. I'm almost desperate now for all central banks just to stop hiking rates as soon as possible and just let the past hikes over the next 12 months work their magic. And if we avoid recession but land at 3% on core inflation, that's absolutely fine. It's much better than a recession that puts the economy back to sleep, and in 3 years from now, we're stuck where we were in 2013 to 15 with no inflation, low interest rates, and this incredibly sluggish economy. The great thing at the moment is economies are awake. They're moving. We have price signals. Employment is strong. It's very, very risky to end this process.
A believer in the monetary policy lag. Berenberg's Callum Pickering, we thank you as always for joining the program. Coming up, we go from the macro to the micro. Intel terminating its agreement to acquire Tower Semiconductor. More on that next. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Intel walking away from its $5.4 billion deal to acquire Tower Semiconductor for no other reason than regulatory issues. Surprise, surprise. We're joined now by Bloomberg's April Roach, joining us all over this deal. April, this was a pretty heavily kind of marketed deal, it felt like. Why is Intel terminating it now?
Yes, so Intel announced this morning that it is terminating its plans to buy Tower Semiconductor due to difficulties with getting regulatory approval on time. And Bloomberg had already reported that Intel was expected to have to call off this acquisition. The deadline for the deal was midnight, California time, on August 15th. And by that time, both companies still hadn't received regulatory approval from China. So under the terms of the agreement, Intel said it would pay a termination fee of $353 million to Tower Semiconductor for this.
Just talk me through why they wanted this in the first place. What was the industrial logic to do this deal?
Yeah, so the deal was part of Intel's plans to get into a faster growing part of the semiconductor industry. And that specifically is the foundry market, where companies make chips for companies on a contract basis. And while Tower Semiconductor had a relatively small presence in the area, it did have the expertise and customer list that Intel was lacking. So Intel was hoping to combine its plants with Tower Semiconductor and really tap in to that client list. But what we've been seeing is that due to growing tension between the US and China, it's becoming increasingly difficult for companies to secure deals that require sign-offs from regulators in Washington and Beijing, particularly when those deals involve semiconductors.
Bloomberg's April Roach all over that story, and we should very quickly point out that the regulatory approvals really did come from all around the world, China as well as the EU, of course. April Roach, again, all over that story. We continue with the corporate story and a look at retail earnings, continuing with Target on deck today. We're going to discuss what to expect from their results. Already seeing a pop in the stock. That coming up next. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance. This is the early edition. I'm Guy Johnson. I'm in London. Kruti Gupta's over in New York. Cree, it is 5:49 a.m. in New York City. Let's talk about the day ahead if you're just waking up. U.S. housing starts, the data there drops at 8:30 a.m. Eastern. We get the Fed minutes. They come out at 2 p.m. We're going to get remarks a little later from Chicago Fed President Austin Goolsbee. That happens at 2:30 p.m. Finally, of course, we get Target. We get TGX reporting earnings before the U.S. market opens.
Well, let's dive into that story a little bit. Target expecting to report its first sales decline in 4 years. Joining us now, Simone Foxman, all over that story. Simone, when I think Target, I'm kind of traumatized a little bit by that one sell-off that we had that one quarter from Target, where it was really all about inventory, and then it kind of took the entire market with it. This time around, are we going to see that same kind of pullback, perhaps, in the retail sector?
Well, on the inventory side, I mean, most analysts are pretty optimistic that the biggest issues are behind us. We did see the company pull down its inventory dramatically in the last 2 quarters, first slowly and then by a bit more last quarter, and we expect to see that continue. This is just moving past those pandemic-era supply chain issues where all of a sudden these retailers had all this stuff. They've been able to use discounts, sell it off, and that will hopefully improve margins. The concern on Target's side is, however, that we could see sales that are even worse than anticipated. What analysts are looking for is negative 3.75% comp sales estimate for 2Q over a year-on-year basis. But some of the alternative data sets, like Bloomberg's second measure, have come in a bit worse. And I think if we were to see something like that, we could see a real negative move on the shares and maybe some impact on other retailers as well.
Okay, so we're going to look at Target. We're going to see what happens there. And then the next thing we're going to do is try and figure out what that means for the rest of the retail sector. Specifically, what does it mean for Walmart et al.? What kind of a read across am I going to get here?
I mean, Target lives in this world, sort of consumer discretionary, but sort of consumer staples, right? And it's really been pushing into the consumer staples side of its business. Food accounts for about a fifth of its overall revenue, and it's been trying to make that even more so. That's an important one for Walmart. That's somewhere that Walmart's really seen some strength over the last couple of quarters. Similar, you can draw this through to Costco, draw this through to some of the other retailers we'll see over the next 10 days plus. And if it can make money on that side, that's a good thing because that shows some resilience, even if the consumer's pocketbook is a little bit stretched. But, I mean, think about what we heard from Home Depot yesterday, which was they saw a pullback in some of those higher-end, $1,000 plus purchases, things like patio furniture and appliances. That's something that could also hit Target as well in its sales of electronics. And of course, that feeds through into Walmart, into Lowe's, other retailers. And so that's something that we're really going to be paying attention to. Exactly what are people spending their money on, and have we seen that weakness on the top end?
Guy, I've got to ask you, have you ever shopped at a Walmart? Just out of curiosity.
I've been to a Target. I've been past a Walmart. I've never actually been into one. But after getting so much grief from Alex Steele a while ago, when I was in Seattle last, I made it a mission to go to a Target.
The Target dollar section.
My producer at the time forced me to do so as well.
Well,
I spent a good half hour in there. It was very exciting. Slightly confusing, but very exciting.
Well, I think what's interesting for Target is that they do a little bit of everything, and that's really, Simone, the business model I think Walmart has tried to adopt as well, because Target has groceries, they have furniture, as you just pointed out, they have that dollar section that everyone loves to go to, but then Walmart is really just kind of thought of as where you get your really cheap groceries and then your fuel, and that's it. Right?
I mean, you know, Walmart does more than that. And I think that they've especially tried to invest in their food business. They've done a big push in that. They've tried to invest in some of their online businesses, bringing third-party retailers in to try and compete with the likes of Amazon. They've taken, I think, a bigger bite out of the retail apple than Target has. Is that a good thing? Is that a bad thing, especially when the consumer is a little bit more strapped for cash? I think we'll see.
I've been to a Trader Joe's. That was definitely an experience.
Trader Joe's is an experience. The lines, every time.
Yeah. Everybody felt so felt like everybody was, it was almost a religious experience going to a Trader Joe's. Is Walmart going to be able to keep the people that have traded down? That's my question for this week.
Well, I mean, Walmart, I think, has this beauty and this curse, right? And that a lot of locations, it is the major, enormous retailer there. And so it draws such an enormous share of business, especially across, places in this country that don't have anything else. The challenge, I think, is the competition, well, on Walmart's basis, is the competition with Amazon, which is increasingly trying to serve those very same customers, really struggled with things like food, but pushing $1 billion into investing in that space. That said, I think if the trade down is only intensifying, then we could see even more people potentially going to Walmart. You look at McDonald's, for example, maybe a decent proxy. They've seen, I think they were looking at comp sales of 12%. That was a very strong among broader consumers for food. So we'll see if Walmart can capture that on the broader retail side.
Bloomberg, Simone Foxman, all over that story. I gotta admit, one of the things I miss about New York is I don't really have access to a Walmart superstore, which makes things a little challenging from this Dallas girl. But let's take a look at some of the stocks we're watching in pre-market trading and a quick check on those retailers here, because of course Target and TJ Maxx, like as we were just talking about, report before the bell, both higher in pre-market trading. TGT is your ticker there, higher by about 0.5%. TJ Maxx not far behind, again higher by 0.9%. The theme there, resiliency, and that's of course going to have some sort of macro read-through as well. Let's get to Hawaiian Electric shares, actually up this morning, and of course we know, just given the devastation that we have seen in Hawaii and of course the carnage in the utilities front as well, you are seeing a pullback in those shares. Is that a fundamental narrative? Not necessarily. That might simply just be a function of buying the dip guy, but you are seeing those shares higher by 4.1%. And lastly, another interesting move this morning, Kava, the recently IPO'd kind of fast food company, higher by about 12%, better profitability in their first update since their IPO. Our markets producer Dan Curtis pointing out that their projected profit margin guy is of at least 23%. The only company in the index higher is McDonald's. So real growth prospects for Kava.
Sparkling performance. Bad joke. Big day coming up. I think Target's going to be fascinating. I'm looking forward to the minutes. We've already got to digest the data out of the UK. Pretty good setup.
A lot for surveillance ahead to digest. That, of course, does it for the early edition. Stick with us. Nikolai Tangin, the Norges Bank Investment Management CEO, joins the program. This is Bloomberg.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park. And that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. Welcome to Balance of Power. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
It's no mystery the consumer is strong.
It's very clear that consumers are beginning to slow their activity.
At the end of the day, this is all about the labor market.
I think there is enough support from the labor market to prevent the U.S. consumer from completely rolling over.
Eventually, consumers will come to the realization that things are a lot more expensive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Nothing quiet about this summer. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market right now totally unchanged on the S&P 500. Here's a cheat guide. If you're overseeing an economy, the second largest in the world, if you're worried about the data, don't report it. If you're worried about the market, ban selling. Lisa, the latest news out of China. We've seen these kind of headlines before. Chinese authorities, according to our reporting, asking some investment funds this week to avoid being net sellers of equities.
This coming with reports that they're recommending that people not say anything negative about the economic trajectory. So if you don't trade it, if you don't report it, then does it happen? And the answer is, at least around the world, yes, especially given that the data they've been reporting consistently has been worse than expected. So then I guess just, in absence of it will make people think everything's gotten a lot better.
Let's put some numbers on that worse than expected. The expectations on Wall Street around growth in China has changed radically. JP Morgan, just back in May, had a forecast for growth for GDP in China, 6.4% for this year. That's been cut to 4.8%, a 4 handle from a 6 handle in just a number of months.
And there are signs that the PBOC, the People's Bank of China, are starting to respond in some way, but it's not clear what they can do to really generate some sort of confidence. The fact, I just want to go back to this idea that they're not reporting the youth unemployment rate. And I was looking at some of the reports about how this is being interpreted. And a lot of people, even in the mainland, are saying, we're not dumb. Like, this isn't positive for sentiment. We see what's going on, and young people cannot get jobs.
Well, let me give you the official line once again. For those of you that might have just come back from vacation and missed the official line, you won't receive youth unemployment. I don't know how long it would take to receive it again, but ultimately, this is the explanation from the National Bureau of Statistics. The labour statistics, quote, need further optimisation, and Lisa, more research needs to be done on whether students looking for a job before graduation should be counted in the labour statistics.
So if you're trying to come up with an estimate for the economy, what do you use? Do you gain confidence? If you don't have confidence, do you use on-the-ground types of measures? Or like Apple, there was a report today, they're moving more of their manufacturing out of China. Do you accelerate that with this feeling that there's a clampdown and something that is not transparent and not available for the projections and the things necessary for an open business?
So the growth in China, not great. The growth in the United States, still talking about an upside surprise on US retail sales. The data just better than expected. Is there such thing as too much of a good thing?
People yesterday were gaming out something like a 5% GDP in the sort of, just for the third quarter alone based on these retail sales. I was looking at Jason Furman, who had some estimates to that degree. Yes, basically, is the answer. I mean, this is what's been fueling this sense that there is going to be hotter inflation. The Fed's going to have to hold rates higher for longer. That said, there are people saying that the money's going to run out. But they've been saying that for how many months?
Months and months and months.
And it hasn't happened.
It's the 3-month rolling recession forecast. It just keeps rolling. Keeps rolling.
At some point, people are going to have to run out of cash, I assume. But their balance sheets are good. Now they're borrowing money for it. Student loans are coming due. They don't have to pay because for 12 months, they're not going to get penalized anyway. So these are some of the sort of offsets that people are pointing to that could keep consumption going. Again, it comes down to the labor market. Everyone keeps saying, unless the labor market breaks, this is kind of going to be how it's going to be.
Neil Kashkari of the Minneapolis Fed speaking yesterday. The work's not done. Look out for the Fed minutes a little bit later on this afternoon. Lisa will give you the time of that. Here's the price action on the S&P 500. Equity futures on the S&P right now, just about unchanged. They're going absolutely nowhere. For 4 consecutive days, yields have been climbing on a 10-year. Over those 4 days, up around about 20 basis points. This morning, down about 3. Lisa, your yield, 417.58.
Today, we do get some more retail sense from the earnings. Target comes out in about a half an hour. TJ Maxx comes out at 7:30 a.m. Very curious to see whether they really represent some of the positive gains that we heard yesterday in the data. So far, the retailing sector is up more than 30% year to date in terms of the S&P, far above what other people are seeing. So this has been a place of strength. 8:30 a.m., we get building permits and housing starts. This, to me, is the biggest mystery. How long can we see this kind of upward momentum, especially given that home builder sentiment did fall off a little bit yesterday? John, home builders, those shares are up 47% year to date.
Go back to last summer. It's even better than that. It's amazing.
I mean, I'm just trying to wrap my head around how long this can continue with mortgage rates where they are. And Fed minutes, you were asking about that, 2 p.m., they are coming out. I did some calculations. Since July 26, 10-year yields are up more than 30 basis points, as you were saying. It really has been entirely focused in the long end at a time where there suddenly is much more dissent on the Fed. That is what I want to see in the minutes.
Interesting to see the 2-year breach 5% just for a moment, a heartbeat after retail sales yesterday.
Gaming out how long rates can remain high. It's less about whether they're going to raise rates again and how long. And that has been the honest theme, and you've seen that priced into the market.
Let's see if we see that theme in a minute, so a little bit later this afternoon. Let's get your market conversation started. We can do that with Ben Gutteridge, the investment director at Invesco Solutions. Ben, fantastic to catch up with you, sir. Underweight bonds, overweight equities. Just walk me through that overweight on stocks right now, Ben.
Well, a pleasure to be with you and really enjoying your conversation. I think the premise behind that overweight equities, not that it's without risk, is on the basis that inflationary pressures can continue to moderate, and as much as that feeds into both supporting consumer spending power and grants the central banks, Federal Reserve, the flexibility to, stay pat on interest rates, cease hiking at least. I think that sort of mix, resilient growth, moderating inflation, less hawkish policy, I think that can continue to support equity markets into year end.
Ben, why do you think that will continue in a favourable direction, given that some people believe to get inflation back to target, growth's got to take a hit?
Well, I think if you look at some of the key components to inflation, you look at the goods element, and, we'll often refer to things like used car prices, or indeed you look at the supply chain index, the frictions within the supply chains, all of that feeds into the idea that inflation can moderate. And then you look at the sort of the shelter component, and again, you look at sort of lead measures such as sort of levels of rents. And again, that suggests that inflation can continue to moderate into year end. Inflation forecasting, of course, not without risk to, what's happening in labour markets, in wages, could well undermine that view. And of course, what we're seeing in energy markets as well. But on balance, I think there's enough in what we're seeing in terms of shelter and goods prices to support a further see inflation continue to move lower into year end.
So why are you underweight bonds, Ben?
Well, I mean, there's a bit of horse trading because we believe equities are the go-to asset class. So it's got to come from somewhere, and therefore, bonds is a natural source of funding. But within that, of course, there is like a risk that growth really disappoints, and maybe we get inflationary risks, maybe we get deflationary risks. Because on the basis you get deflationary shocks and equities get punished through that route, then we want to have some duration in that underweight bond component, sort of a bit of sort of portfolio management nuance in that. But because you're underweight bonds, we want duration to hedge against the overweight equity.
So perhaps just using cash to extrapolate out into a little bit more risk. I'm looking right now at the year-to-date returns and then the month-to-date returns. The NASDAQ leading this sort of correction light, I want to say, down about 5% this month. Is it a buying opportunity? Is it a pause? Or is this a reallocation within the market under the hood to different areas?
Well, I think, like on balance, you would say it's a buying opportunity. Look, there could be an even more attractive buying opportunity in the coming days, weeks, months, but on a 12-month view, as I said, on the basis we think, certainly 6 to 12-month view on the basis that inflationary pressures can moderate and growth can be resilient, then these parts of the market, I think, would perform in that environment. Not a one-for-one relationship, as we know, between bond yields and sort of loosely defined sort of tech stocks, but there is something to it. And yeah, on the basis that yields might move lower from here on the back of lower inflation, think it looks like a reasonable buying opportunity, but maybe not the best buying opportunity.
Lisa, I was going through the price action yesterday, looked at stocks, difficult session, looked at credit, barely noticed.
Yeah.
375 high yield spreads near the tights of the year.
And we've heard people say they're hiding out because you get both sides of everything, and these companies have sort of termed out their obligations, and so it looks like it's pretty good.
Everybody's worried about a maturity wall on the horizon, but they're not really worried about it.
It's not yet.
There is this belief that they're going to reduce interest rates before we get there over the Federal Reserve. Can you take comfort in that?
Me personally, I
Sure.
can't take comfort in anything. You know that. I mean, I just am going to worry about everything, and I'm going to suggest that at that point, how bad does it have to get for the Fed to cut rates? And what does that mean for the credit component of some of these companies? In other words, yeah, the maturity wall is further out, but if things deteriorate before then maybe people will demand a higher premium.
Ben, there's always something to worry about. Work with me here. Let's worry about this. There is this maturity wall out there in the distance. It's out there in 2025. We know that high yield companies would ideally deal with that at least a year beforehand, and markets are going to start thinking about it too. There is this belief that the Federal Reserve starts to cut interest rates in the middle of next year. We've seen policy start to shift, at least pricing of policy start to shift in a more hawkish direction. Ben, when do you think there is a less favourable way of looking at high yield credit and the ability of some of these firms to refinance next year, with the idea being that the Fed's going to hold for a whole lot longer than maybe some people think?
Well, I'm afraid you can't sort of strong-arm me into a position of great anxiety. I'm afraid I would be of the mind that, yeah, many of these businesses have done a good job at terming out their financial position, meaning the debt obligations aren't going to be so onerous moving forward. And as we get into 2024, yeah, I think when you're thinking about mild recession type environments, inflation continuing to moderate, maybe they can at that stage next summer be something of a move lower on interest rates, which would give markets and businesses some ease about the impending refinancing challenge that might lay ahead thereafter.
Right now, Ben, when you look out, what is your main potential risk? I'm not going to strong-arm you into a great place of great anxiety.
You're going to try.
But I'm going to try. So what is your sense of kind of what could be out there that could make you reassess at least this gradual disinflation that a lot of people seem to be betting on?
Well, the disinflation narrative reversing, if heaven forbid we have a replay of 22, you know, and inflation surprises to the upside on an ongoing basis, and central banks turn more hawkish, that would be pretty bad news for our strategy for positioning in general, markets in general. And unfortunately, we are sort of seeing signs of reviving inflation in commodity markets, labour markets staying strong. Even falling inflation itself can bring about its own demise in it, that it supports demand and can see a re-acceleration of goods prices. We're seeing longer end of bond markets, you know, tips yields sort of move higher. So, you know, that is not an insignificant risk to the core view.
Hey, Ben, you're a strong man. It's good to catch up. Ben Gutteridge there.
Thank you.
With Invesco Solutions. Thank you, Ben. Thank you very much. Neil Dutter of Renmac might have things to say. He pushed out this quote in the last couple of days. I'll share it with you. It's worth thinking about. You either believe a period of below potential growth is necessary to quell inflation, or you don't. He goes on to say, given the tailwinds from housing, motor vehicle and airplane assemblies, inventories, consumption, the US economy is nowhere near a below potential growth situation. He's concerned this Fed is embracing this soft landing story too soon.
That they're embracing in a very quiet way transitory or immaculate disinflation, that these are some of the post-pandemic normalization effects. And Neil Kashkari, you mentioned him, and I was looking at his actual comments yesterday, and he said, I want to see convincing evidence that inflation is well on its way back to 2%. We don't need to get there tomorrow. We can allow it to gradually get there over time. How gradually? Does it matter how long? I mean, at what point does it become embedded and concerns and all of this stuff? And, you know, these are some of the questions, and it goes to Neil Dutta's point.
You're going to be sick of talking about this in about a week. Jackson Hole, a week away.
I will never be sick
Got
of
3 days
never
of
be
talking
sick
about
of trying
this.
to strong arm people into
Non-stop.
feeling
In Jackson Hole, Wyoming.
deep
Looking forward to
anxiety.
that coverage with you on Bloomberg TV and on Bloomberg Radio. TK's taking a little bit of a break. Hopefully he'll be back before the weekend and into next week to cover Jackson Hole for you all. Coming up a little bit later in the next hour, Stuart Kaiser of Citi on this equity market. In about 20 minutes, we'll get numbers from Target. Just another flavour of what's happening in retail in America ahead of Walmart tomorrow. Live from New York City this morning. Good morning.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
DOJ or other authorities.
Could face bigger challenges. What's next?
It was going to keep bringing World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
If David Solomon were to be fired today, I think the stock would actually go down. When I talk to investors, investors aren't saying, oh, get rid of David Solomon. They're really asking the questions you're asking. Hey, does the media impact their performance? I'd say no so far. Having said that, David Solomon has to earn his job every day. And so I can come back in 3 months or 6 months and he doesn't get the job done, I'll be on the other side.
That was Mike Mayo, the head of US large cap bank research over at Wells Fargo, speaking earlier this week on the future of the Goldman Sachs CEO, David Solomon. Some fresh reporting this morning from the team at Bloomberg, including Bloomberg's Sri Natarajan and Shanali Basak, on the future of Goldman Sachs CEO, David Solomon, and his possible successor, President John Waldron, writing the following: as bitterness festers in the ranks this year over Solomon's leadership, Waldron is being pressed by colleagues to pick a side, beat his own path to win over disgruntled executives, or risk being seen and as an affable clone of the CEO. Joining us now, I'm pleased to say, is Sri Natarajan of Bloomberg. Sri, let's start there. The push, the pressure that this guy is under to pick a side. Has he picked a side?
No, I mean, there is no outward indication that he is going out there and saying that he's breaking ranks with the CEO. At the same time, it is clear that as he does his listening tour across the firm, he is listening to the frustrations and acknowledging the frustrations. The challenge is that he is in a very difficult spot. John Waldron, when he started his career at Bear Stearns, was tied up with David Solomon in the early 90s. For the last 30 years, he's climbed the Wall Street ladder right behind David Solomon, first at Bear Stearns and then at Goldman Sachs. Now you have a situation where it's clear that he was the presumptive CEO in waiting. He is the sole president of Goldman Sachs. And 2 years ago, if you had to ask anyone when the next succession happens, whenever that might be, tomorrow, day after, 2 years from now, John Waldron was the most likely one, was the obvious one. It doesn't appear that obvious anymore in the middle of everything we're seeing and the voices we're hearing from inside Goldman.
I remember the previous obvious successor to Lloyd Blankfein. That was Gary Cohn. You mentioned this in the story this morning. How do you avoid being Gary Cohned at Goldman Sachs?
it's a big risk. It's not just a Goldman Sachs risk. It's a risk in corporate history. Anyone who has been a long-time number two, unfortunately, runs a risk of always being seen as a deputy. At the same time, let's look at what the criticisms of David Solomon are. It is not a CEO who's run the firm into the ground. In fact, it's not at all the case. The stock's up quite a bit. The core investment bank has done well. They've done well with clients. They've had some successes in alternatives, fundraising. And therefore, if you had to think that John Waldron is in sync with David Solomon on strategy, that's not a problem. A lot of the criticisms about Solomon emanate from the personality. They are personality criticisms, which have a major bearing. But you don't hear the same things about John Waldron, who clearly seems to be much more well-liked across the firm.
Just to build on that, you quoted a recruiter in your piece saying some people would choose loyalty over ambition, but I think many people would choose ambition over loyalty. And spoken like a true Wall Street aficionado, I'm curious from your vantage point what it means to have loyalty, right? How split is the firm? How much has David Solomon lost the room?
Think about it, at least to start with, a little bit like the House Freedom Caucus. It might not be the majority of the partnership, it might not be the majority of the group, but it is a loud, vocal group that has influence across the firm. And these are not irrelevant executives who are making this charge. There are a lot of people, you know, if you look across the ranks of the top 20, 30, 40 partners of the firm, not many of them will openly tell you that they're completely behind David Solomon and they'd like to see him for 5 years. So yes, there is clearly a split. Yes, there is clearly a schism there. And that's the challenge that Waldron faces.
Mike Mayo of Wells Fargo came on and suggested that part of this disgruntled feeling within the ranks has to do with the fact that investment bankers weren't paid as well last year, even though they really led the firm in terms of profits. Does that ring true to you?
That is interesting. If you go back 10 years, for the longest time at Goldman, at any other Wall Street bank, the constant criticism we heard about the media was we are the ones portraying Goldman executives, banking executives as greedy whiners. All that they care about is money. But last week, there was a really damning magazine story about what is happening inside Goldman Sachs. And the spokesperson of the firm was the one lashing out at the rest of the partnership at Goldman Sachs, saying they are all complaining because they're upset about pay. Or at least that was the undertone of what he said. That is not something you hear normally. And therefore, I'm sure the partnership, I'm sure the people who are upset with strategy will tell you it's not all about that. They will say it's not about that at all. But the fact is, yes, there have been strategy missteps. The market did turn, which did bite into profits, and therefore did also take a big bite out of pay.
Can I just ask this question? It's something I've been thinking about. If no one likes this guy internally, based on media reports, how did he get the top job in the first place?
It's very interesting because remember when Lloyd Blankfein was stepping down, he had set up a proper succession race. It was a two-horse race between David Solomon and Harvey Schwartz, who, after a little bit of time on the beach, is now the CEO of Carlyle. And at that time, the assumption was it was always likely going to be Harvey Schwartz. He was seen as Lloyd's guy, he was a trader, and everyone just automatically assumed it was going to be Harvey. Lloyd and the board did pull a rabbit out of the hat. David Solomon was a surprise pick, and he had business success. He had done well on the investment banking side of things, which is a business that he was running. He had improved the returns profile there. So when he was named CEO, it wasn't as if there was great disappointment. But over the last 5 years, especially through the pandemic, and as the markets have turned after that, it's clear that a image about David Solomon has been etched in stone inside Goldman Sachs, and it's going to be very hard to turn that around in a day or two or a month.
If you're running this bank, I imagine you're less concerned about how your image is being played out in the media. You're more concerned about clients. Are clients concerned? Do investors really care, based on what the stock has done, based on what the firm has done and how they've executed under Solomon's tenure?
Two important constituencies, the clients and the board. We have no indication that the board is out there saying, what shall we do about David Solomon, right? In fact, we also know that Goldman Sachs trotted out comments from its lead independent director, Bayo Ogunlesi, to its staff saying that he's happy with stock performance. He thinks it has done well relative to rivals. So they have tried to signal subtly, or maybe not that subtle, that the board is behind David Solomon. The question about clients, though, gets riskier. We've had a lot of conversations with corporate CEOs, with private equity firms, with hedge funds, where they are increasingly asking us questions about what is the mood about David Solomon. They tell us that a lot of their meetings with Goldman Sachs people is spent on asking about what is happening inside Goldman Sachs and then moves on to more important constructive things that they're actually there for. So there is clearly some concern and uneasiness among clients. And if that grows, that is when you see a real problem. There is no indication that there is a real problem to David Solomon's position as CEO. Yes, there is a lot of griping, and yes, there is a lot of dissatisfaction. That doesn't necessarily translate into David Solomon not being the CEO of Goldman Sachs.
John, you know, when we were talking a lot about Goldman Sachs, I was wondering, how are the banks doing? We've seen yields go up. They typically are supposed to do better when yields go up. They've done really poorly this month. Goldman Sachs shares are down about 6%. But if you take a look at Citigroup's shares, they're down about 8%. And you could see the Bank of America stocks are down a similar amount. JP Morgan down 4.5%. I mean, it's sort of surprising considering the environment. No?
They've outperformed the sector, haven't they, under his tenure?
That is important. Over the last 5 years, Goldman Sachs has done well relative to peers, right? It is behind Morgan Stanley, and that doesn't make anyone at Goldman Sachs happy. They're a distant second.
We can blame Gorman for that, right?
Yeah, you should blame Gorman for that because, look, he has run a drama-free firm. Like it or not, that's the reality about Morgan Stanley. But behind Morgan Stanley, there's Goldman Sachs. Jefferies Pure Play Investment Bank has also done way better than Goldman Sachs. But after that, Goldman Sachs and JP Morgan, and then come the rest. But over the last 2 years, the stock has been stagnant. A lot of the stock price growth has been driven by the expansion in book value. Earnings has grown, driven by the part of the firm that the Goldman management wasn't keen to tout, trading and investment banking. They wanted us to look at consumer banking, at wealth management, asset management, hoping to get a higher multiple. Investors haven't rewarded them for that. And that's important because a key pillar of David Solomon's strategy was to make sure that this stock gets re-rated. The stock advance is tied to the growth in earnings from the old Goldman Sachs, from the part of the Goldman Sachs that is really good at what it does, from what makes Goldman Goldman, its bankers and traders.
This speaks to exactly what Mike Mayo said, which is this is a bunch of traders who don't feel like they've been rewarded based on how they've executed over the last couple of years. And the more and more we have this conversation from the people that know what's going on inside the bank, like you three, the more I walk away feeling like this is just deeply personal and not strategic.
There is a strategy element to it. At a place like Goldman Sachs, where we point out in the story, that is a firm where even the use of a red pen on a trading floor is seen as a harbinger of bad luck. Their mistakes are magnified.
I feel the same way about red pens. Don't
you? Serious?
Oh, yeah, throw them away. I see them on a desk.
Why?
Yeah, every time. Same reason.
I don't care. I'm not superstitious.
Three, thank you. Great reporting, sir,
Really?
alongside Shanali. Thank you very much.
out?
Don't do that. No, don't use red pens, Bremo.
Why?
It's bad news.
Why?
It's what teachers do. Angry teachers. They sort of like, you know.
It's like trauma from grade school?
I wouldn't call it trauma.
Like it was like
From New York City,
3.
maybe. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Let's get to the price action for you on the S&P 500. Totally unchanged. The story of the week so far. What Monday gave us, Tuesday took back. Totally unchanged now, basically, on the Nasdaq, on the S&P 500 for the week. The S&P 500 slightly negative over the last couple of days. Early days. The week is still young, but poised for a third week of losses on the S&P 500. Potentially, if we did close here, just something to think about. 3 weeks of losses would be the longest weekly losing streak of the year so far, Lisa. So that, I think, paints a picture of how good 2023 has been to date.
It's been tremendous, and it's been led by the tech shares. I was looking at what was leading some of the declines, and it is the tech names, but it's also some of the meme stock types of names as well. So it is the sort of like froth that was built into the market over the first half of the year, just being taken off. And we keep hearing buying opportunity from a growing number of people who are trying to take advantage.
Repeatedly. Into the bond market we go. 2-year, 10-year, 30-year, shaping up as follows. The 10-year yield at a new high for the year in yesterday's session. That new high just short of 4.27 on a 2-year. Had a little bit of a sniff of 5%, then backed away after breaching that level very briefly after retail sales, breaching that level for the first time since early July. This morning, your 2-year back to 4.90, down 4 or 5 basis points on the day. The 10-year down to about 4.17.19. We're down about 4 basis points on a US 10-year. Want to turn to the FX market. I know it's only Wednesday, but again, if we closed here, 5 weeks of losses for the euro, potentially. That would be the longest weekly losing streak going back to March 2022. The euro this morning slightly stronger, trying to do something about that. 109.20, we're positive by 0.1%. We've talked a lot about the earnings so far this week. We've had numbers from Home Depot. They didn't really impress too much. Walmart tomorrow, Target right now. The headline on Target that you need to know, they've cut the outlook for EPS. The new range for full-year adjusted EPS is $7 to $8. They had seen previously $7.75 to $8.75. The numbers for the quarter, Lisa, I believe a miss on the top line, but a beat on the bottom line. The stock is higher here by 4%.
Which is surprising considering that they cut their full-year adjusted earnings per share. So I'm curious to go through some of these numbers. But they did talk about same-day services growing about 4%, led by a 7% growth in Drive Up. They're talking about digital comparable sales. I'm curious to see, again, if this is basically another kitchen sink. Can they do that? How many kitchen sinks can they have before people are kitchen sinked out?
Can you buy kitchen sinks at Target? You can buy everything else, can't you?
I'm not sure whether you can buy kitchen sinks, but you can buy the soap to go on the kitchen sink.
Target right now is up by about 5 or 6%. Walmart coming up tomorrow. We'll recap those earnings in just a moment. Under surveillance this morning, the top story, China authorities asking some investment funds to avoid being so-called net sellers of equities as the markets drag lower. Several large mutual fund houses were told to refrain for a day from selling more onshore shares than they purchased, according to people familiar with the matter. So they're not banning selling per se, Lisa, but they're trying to make sure people don't sell too much.
How do you have a market, and at what point does this really scare away a lot of foreign investors? There's a tension where the authorities in China have been trying to lure back some of the international businesses that have been skittish because of the increasing hard line that they've been taking. What does this do to that? If you don't have the confidence of where they're going to allow share selling, how do you then operate a business in a way that is similar to how you do in the rest of the world? And this is a real issue that we keep hearing from executives.
They did something similar in early 2016. The question I would ask is, does this kind of thing work?
No.
Does it work?
I mean, the issue is work in what way, right? Because does it work for market sentiment, market feeling? No. Does it work for at least not perpetuating the bad news among the population? Maybe. Is this targeted for a domestic consumption, as you said yesterday, versus an international one that maybe has less import at a time where they're trying to triage, given some of the numbers that they've been putting out?
The latest on China this morning, the equity market has been a big drag, down for 4 days. I believe the CSI 300 over that period, down about 4%. Fed minutes due out a little bit later this afternoon, 2 p.m. Eastern time. The account of the latest policy meeting likely to show that a minority of officials favoured holding rates steady through the rest of the year. Elisa, I think a lot of people are on that page. Kashkari pushing back, saying the work is not done. They've just been flirting more recently, though. I'm thinking of John Williams at the New York Fed, just embracing, engaging in this conversation about cutting interest rates next year. I know it's not to ease policy. It's just about stopping policy becoming more restrictive. But once you start engaging in that conversation, are you sending a signal?
The irony is they are sending a signal and the market's not getting it. They're getting the opposite one, which is that perhaps the Fed is going to be blind to a persistent inflation that's going to remain hot and that's going to force them to keep rates higher for longer. There's this feeling right now that there is a patience on the Fed to wait, that they can take a look at the data as it comes in and they can sit and they can hold on in September and even November and just watch it percolate out without the fear of a policy error. Does anyone push back against that? That's what I want to know at Jackson Hole. Is anyone saying, no, actually, now is the time to act if you believe that inflation cannot come down unless there is preeminent weakness in the economy?
The annual get-together, about a week away.
Yeah.
About a week away. Oh, yeah, can't wait. Thrilled about this stuff.
Do you have a
Going to sit in the freezing cold.
Yeah.
A cowboy hat.
Yeah,
no, that's a Mike McKee thing. I don't think they suit me at all.
Bears.
With bears?
Yeah. Like just coming around saying hi.
You're trying to scare me about bears?
No.
Is that what you're trying to do?
I don't really have to try.
What are you doing? No,
I'm trying to, strong arm you into a state of perpetual anxiety.
It's a safe default position to be petrified of bears.
No, they don't want to hurt you. It depends what kind.
Sure. Grizzlies?
Grizzlies,
no, thank you.
Basically.
Yeah.
But,
no,
they're not going to come by. They're Fed officials. Like,
Okay. All right. You're too excited about this. Like a child going on vacation. It's work, Bramo.
Oh, I know.
It's not a vacation. Let's turn to this story just to wrap things up for you. The death toll from Maui wildfires topping 100, but only 5 victims have been identified so far. Just deeply depressing statistics in the last 24 hours. The cause of the fire still under investigation, but increasing scrutiny has been over the power equipment as the possible source, leading to a record slump in shares of Hawaiian Electric. That stock, Lisa, hammered over the last couple of days to start this week.
It's such a tragedy, and the fact that there are reports of people on the island being asked to provide DNA samples so that they can identify more people as they go through the rubble. The question for me on a longer-term basis, once we get beyond the tragedy, which a lot of people will suffer for their lives, there is a question of what this means for insurance policies, what this means for businesses that are going to operate in some of these high-risk environments. You think about all of the floods, the fires, the hurricanes, and you start thinking about insurance policies that are getting revoked in places like California, Florida, and now you have to wonder what's going to happen with some of them in these certain areas.
Super serious issues. We'll try and keep the coverage going for you on Bloomberg TV and on Bloomberg Radio. Let's turn the conversation to Jennifer McKeown, the Chief Global Economist over at Capital Economics. And Jennifer, let's start with the economic data out of the United Kingdom. We've seen the wage growth figure, record wage growth, looking at core CPI out of the UK this morning. Pretty tremendously sticky in a view of many people. Jennifer, there is this belief that maybe the Bank of England needs to go even further. Many people from the outside looking in, including the people on the inside, focused on what's going to happen here to the housing market. Can you run us all through where the effective rate is on the average mortgage right now in the United Kingdom and how painful that's going to be in the next 12 months as it climbs higher?
Yeah, okay. Well, that's, I think, a really key issue for the UK economy and for the Bank of England, and I think feeds into this debate about how long interest rates are going to stay higher for. Mortgage rates, new mortgage rates, are already up at about 6%. But given that most people now in the UK are on longer-term 2-year fixes, whereas previously we were more on variable rate mortgages in the UK, that's feeding through fairly slowly. We think that probably around 2/3 of those with outstanding mortgages haven't refinanced since the MPC started to hike interest rates. So looking over the next 6 months or so, it's very clear that more people are going to need to refinance on far higher rates than they have currently, and that's bound to have implications for the housing market. House prices have already fallen by about 5% in the UK, and we think there's probably a further 5% or so to go, so a 10% peak to trough, which will have knock-on implications for the wider economy, the upside of that being that it should ultimately help to bring inflation down.
10% of a decline is actually, it sounds like a lot, and it is a lot for many people. But I'm actually surprised at how tame it is relative to certain prognostications about a 30% decline, at least in the U.S., if you were to look at the price that people pay relative to their incomes and how much it's gone up. Given the fact that CPI came in hot yet again, does this basically mean that the Bank of England has more room to hold rates higher or even raise them much higher than you previously thought without causing an incredible amount of pain among a population?
Yeah, I mean, there's already quite a lot of pain, even with wage growth as high as it is. Inflation's still marginally higher, and people are really feeling the strain. You can see that in the consumer spending figures to some extent. The bank, I think, will need to hold rates higher, certainly for longer than we expect the Fed to. We think there's probably one more rate hike to come in the UK, and then after that, we think that rates are probably going to stay at these kinds of levels for about a year. The Bank of England's made clear that it expects rates to stay a bit higher for a bit longer to really tame these inflationary pressures, particularly stemming from the labour market. A major issue in the UK, as you'll know, has been this drop in labour supply, which has made the labour market very, very tight and suggests that some of this wage pressure is going to persist. So I think probably about a year of higher rates and a year of pain for a lot of people dealing with that before ultimately a recession brings inflation down and allows the bank to start cutting probably late next year.
All of this sort of highlights a debate that we've been having for a couple of months now, which is, are we witnessing long and variable lags? Or is this showing that rate hikes don't have the same effect as many people expected them to on both growth and on inflation?
Yeah, I think a lot of it is about a longer lag, and a longer lag particularly in the UK than we have seen in the past because of this shift in mortgages. But to some extent, you know, that feeds into less of an impact. If it takes 2 years for the impact of monetary policy tightening to start to hit real people, then it may be that by the time people are needing to refinance, then rates are actually coming down again. So I think this longer lag can also mean slightly less of an impact than we've experienced in the past, but really it remains to be seen just how damaging that this tightening cycle is going to be. I think what is clear is that there is more pain to come, even if rates are already at a peak.
Jennifer, the base case in this country has shifted somewhat to a more favourable outcome. There's just this belief held by a lot of people that we speak to on a programme like this that perhaps you can engineer that so-called soft landing. You can get inflation back towards 2% without a recession. Is the base case in the UK now that they would need a recession at the Bank of England to get CPI back towards 2%?
Yeah, I think we agree with that view on the US. It does look more like a soft landing is going to materialise now. Thankfully, it's very clear that the underlying core rates of inflation are coming down, but there's much less evidence of that in the UK, as we saw in the inflation figures today. Now, it is the case that the UK has lagged behind the US. Same goes for the Eurozone. Inflation was later to pick up, will be later to come down too. So we can take some reassurance from what's happening in the US. But I think the situation in the labour market, both in the UK and the Eurozone, is a bit different. This continued tightness in the labour supply, which is very much a feature of in the UK, isn't the situation in the US, where the labour supply is now considerably higher than it was during the pandemic, and that suggests that wage growth is going to there's going to need to be more action from the MPC to bring wage growth down than there is from the Fed to allow a continuation of the easing that we're already seeing in the labour market.
Jennifer, just what is constraining labour supply in the United Kingdom? What's behind that?
It seems to be long-term sickness, perhaps related to long NHS waiting lists, which really backed up during the pandemic. So it's not something that's going to go away overnight, unfortunately. It's not just a migration situation. Some people have pinned it on Brexit, and yes, migration is playing a role, but I think it's a lot more about long-term sickness, and until these NHS waiting lists have come down, that's going to continue to be a feature.
That is dark. Jennifer, thank you. Jennifer McKeown of Capital Economics. Just another example, Bramo, of working through post-pandemic normalisation. In the UK, it's taken a while. We've got record wage growth and tight labour markets, and we're constrained on the supply side for a number of reasons, including the one that Jennifer just explained.
Dark is the right way to describe it, if that really is what the main constraint is, and how much is that really constraining labor around the world. You know, I was just looking through Target just quickly because I was trying to understand why the shares are up more than 10%, and I'm trying to understand why, since they have a negative outlook for the rest of the year, they had a strong profit, and so maybe that's enough to avoid the worst case scenarios.
Profit bouncing back, apparently. We'll see if that move sticks. There's always a knee-jerk reaction after earnings. I've got no idea what this does around the opening bell. More on that a little bit later. Coming up shortly, the CEO of Hong Kong Exchanges and Clearing. That conversation coming up next from New York. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We've been calling it a shift from made in China to made by China, and I think they're going to pursue strategies that help their companies sell their products globally, largely to the autocratic, resource-rich nations that are shipping a lot of commodities to China, and that'll be kind of the quid pro quo. We buy your commodities, you buy our goods. But I have a lack of faith that even if the Chinese companies do well, foreign investors will do well. I'm just worried that China will do things over time to hurt foreign investors if they see fit.
It's the perspective from Peter Cheer, the head of macro strategy at Academy Securities. Always fantastic to get his view on things, particularly on what's developing internationally. Here's the story of what's developing stateside right now in the equity market on the S&P 500. Equity futures are just about positive, but basically unchanged. Yields coming back a bit, down 3 basis points on a 10-year, 4.1777 on a 10-year yield. But Lisa, the move we've seen over the previous 4 days, it's been pretty fast and much higher on a 10-year.
And it really games out the idea of rates longer, higher for longer, but also of this premium placed on U.S. debt with an increasing number of investors maybe pulling back on the margins. And I think of sovereign investors in particular, whether it's Saudi Arabia or China.
Let's talk about China, and let's talk about Hong Kong more specifically. Hong Kong Stock Exchange missing profit estimates today for the second quarter. Sluggish trading, a slow pace of initial public offerings, raising some questions about the future. I'm pleased to say that joining us now is Nicholas Aguzin, the Hong Kong Exchanges and Clearing CEO. Nicholas, wonderful to catch up with you, sir. We want to talk about what's developing on the mainland, but also I have a more pointed question for you. Are you expecting the government to lower stamp duty to boost trading?
Hi, Jonathan, and good to be here. It's you know, the thing that we're most excited about is about what we've been doing in terms of making our market more accessible, making sure that we continue lowering our costs. We cannot manage the stamp duty. I mean, what we've been doing is we lowered the trading tariff for a lot of our participants, and what we're seeing is that the market is very vibrant on the derivative side and a little bit softer on the cash side. But as you know, our results were up 31% on a net income basis, so we're very glad about that.
You can't do anything about it, but have you spoken to the relevant authorities on the issue?
We're constantly talking to all policymakers about how to improve our markets, how to make sure that we make it more vibrant. That decision is something that they do it on themselves, and they take into account all the different factors in terms of like the benefits that there may be, pros, cons, etc.
You'll forgive me for labouring the point and jumping back in, Nicholas, but if we could answer a little bit more clearly as to one, whether you've had that conversation, and two, whether you think it would make a difference. It's just a yes or no. Has that conversation taken place?
Yeah. Yeah, we are not currently engaged in any conversation.
Right now, there is a larger question as you talk to clients, you emphasize what you are doing. Do you get a lot of questions around what you're not going to be able to control in terms of what the authorities are going to do, whether it's limiting how much you can sell versus buy, or what kind of free market parameters are put around share trading?
Yeah. Hong Kong is a very international market, as you all know. There's no restriction in the flow of capital. I mean, we're very exposed to like all the activities that happen around the world, and therefore, I mean, it's the same as like most markets around the world. So, free flow of capital, access to information, free access to information, and what we want to do is to make sure that we continue connecting East and West. That's our core objective, and that's what we've been doing and improving in our market.
How much are you seeing companies and, frankly, investment banks shift to Singapore, which is something that we keep hearing about as an alternative to Hong Kong, just as it gets more connected to mainland China?
Yeah, I do think that during the COVID period, it was a challenging period for Hong Kong. At this point, I mean, I'm not seeing a lot of that. I mean, on the contrary, I do see a lot of people that are returning with the new availability of flights and being able to move around. We're seeing a lot of visitors come in, and we're seeing more and more people coming into Hong Kong. International bankers are coming here, finance companies, hedge funds, etc. So we are seeing this, you know, as a much more vibrant environment compared with the last 2 years.
5 years ago, 10 years ago, a lot of the bankers, the international bankers who came to Hong Kong were from the U.S., from the United Kingdom. Has that demographic shifted? Are you seeing more from other places that are outside of the main European and U.S. markets?
Yeah, we are seeing people come from all over the world. I'll give the example. Last year, we hired our CFO at the Hong Kong Stock Exchange that came from Brazil. He used to be the CFO of B3. So people are coming from Southeast Asia, from the Americas, Europe, and so the demographic continues to be very international in Hong Kong, with people coming from all over the world.
Nicholas, you're going to love me by the end of this conversation, but I just want to ask another question, if that's okay. We're reporting that Chinese authorities have asked some funds, some investment funds in China this week to avoid being net sellers of equities. Can I just ask you if you're familiar with that request?
Yeah, I'm not aware of any of that, and essentially, you know, our role is to have like robust, transparent markets in Hong Kong. You can come and hedge exposure, whether it's buying, selling, totally free market, and totally available for investors to hedge their exposures, whether it's a net short or a net sell.
Do you think those kind of decisions undermine transparency?
Again, I'm focusing in our own markets. So our own markets are very transparent, very liquid, and right now our focus is to allow the markets to determine the prices.
Does it frustrate you that in many cases your home market is conflated by what happens on the mainland? Does that make doing business increasingly difficult?
Our market is affected by geopolitics, is affected by the global macro environment, and we've been trying to make sure that we provide even more tools for investors to hedge some of those positions that they may have. And that's why you see that our derivatives business actually in the last quarter had a record number. We traded 1.4 million derivatives per day. So the role that we have is we want to be a risk management center for those people that want to invest in China, also for people from China that want to invest around the world. And we think that we perform an amazing service at doing that.
There is a belief at the moment that investing in China is becoming more difficult because of a lack of transparency. We've talked about the youth unemployment rate no longer being published. There are official reasons for that, and there are reasons that the majority of people that we speak to believe, which is that it's high and they don't want to report it anymore. Does that undermine some of the volume coming through your exchange that would typically take exposure to China, which now sees some of these issues as, quote, uninvestable at times?
I think that the world is massively underinvested in China, and similar, China is massively invested the world. So what we see is that over time, even though we may go through some periods that are certain lows, over time we're going to see more and more investments coming into China, because China represents 18% of the global GDP, and today when you look at international funds, I mean, it's only about 1 to 2%. There's like 60 to 70% of the funds that today have zero investment in China. I don't think that is sustainable over time. Now, we may see some ebbs and flows because of macro situation, geopolitics, but if I have to bet on the long term and the growth opportunities, that is a massive opportunity. So you may see some periods of time where volumes go down and others that go up, and we've seen that over the last couple of years. But at this time, if I have to guess what the best thing is to focus on the medium term, long term, and in the long term, I don't have any doubts.
Well, we appreciate the update this morning, sir. Thank you for being with us. Nicolas Saguzin there of Hong Kong Exchanges and Clearing. A gentleman in a difficult position at the moment, given, Lisa, what's developing elsewhere.
Especially because there's a lot that's out of his control. And there's a lot that people are saying, exactly, and there's a lot that people are saying about the dynamic that is causing an increasing number of businesses to at least raise questions, or some of the investment banks in the U.S. to reduce their presence.
Open, transparent, credible, ready for business. That was the pitch of Hong Kong, right?
The fact
is that still the pitch now? Is that a credible pitch?
The fact that it was not the mainland. And yet, clearly, the increasing ties have challenged that proposition.
Stuart Kaiser of Citi on the stock market coming up very shortly. Your stock market this morning, a welcome snooze. A snooze, a breath of fresh air.
Now.
Given some of the volatility recently, equities going absolutely nowhere on the S&P 500. Yields come back in by 3 basis points. Your 10-year, 417.97. From New York this morning, good morning.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kayleigh Lange.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
It's no mystery the consumer is strong.
It's very clear that consumers are beginning to slow their activity.
At the end of the day, this is all about the labor market.
I think there is enough support from the labor market to prevent the U.S. consumer from completely rolling over.
Eventually, consumers will come to the realization that things are a lot more expensive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I love Bob Dole. That quote there, eventually. It was like eventually 6-9 months ago, and we're still sitting here and saying eventually the consumer will weaken. Live from New York City this morning. Good morning for you all. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. Your equity market right now unchanged on the S&P 500. Lisa, eventually we'll see some weakness in the U.S. consumer.
This seems to be the mantra, and now increasingly I think there is a new feeling in markets that maybe eventually isn't going to come unless there is some sort of break in the labor market, and that I think is the tension that you feel in the bond market right now with yields up so significantly on the long end.
Earnings season, are we starting to see signs of it? Just a little bit. We've talked about the airlines a few times, JetBlue, Southwest, the domestic players. Are we starting to see signs that maybe the domestic demand is starting to tail off just a bit?
It depends where you look, because you see certain companies that have serious pricing power. You think of Coca-Cola and Pepsi, and clearly people are willing to pay for shrinkflation and whatever else. But other places, not so much. So at what point do you just see people prioritizing their allocations of cash versus wholesale rebellion against pricing? You know, this to me, I think, is what we're looking for. And it's a spotty picture. It's not happening fast enough.
I know people who drink Diet Coke in the morning for breakfast.
Oh, yeah?
Do you know those people?
Yeah, yeah.
Gross. Absolutely
Really?
gross.
Are you trolling somebody who's watching right now?
Maybe.
Yes.
But gross.
Okay.
Disgusting.
You do you.
You do you, apparently. Let's get to the price action on the S&P 500. If you do drink Diet Coke for breakfast, you do you. Equities unchanged on the S&P. Yields down by 3 basis points on a 10-year, 417.97. A new high for the year, though, on a 10-year yield, Lisa. That new high is about 427, just short of that in yesterday's session.
Yeah, just a shocking move on the long end today. We did get earnings from Target, and we're trying to understand the move, which is up, considering the fact that their earnings projection going forward is down. But they did have a surprise profit, even though they did see sales decline. We're trying to parse through it. We're getting TJ Maxx at 7:30 a.m. After the bell, we get Cisco on the tech side. did. 8:30 a.m., this is the other mystery. Okay, on one hand, retailers, how long do they have pricing power? On the other hand, builders, how long can they keep building homes and selling them for higher and higher prices? How much does sentiment start to fall off, given the fact that home builder stocks are up 47% so far this year? And at 2 p.m., the Fed minutes come out. And I am curious about whether there is a comfort with this feeling of waiting, whether we start to get a little bit more dissent among Fed officials at a time where the market is gaming out higher inflation and higher yields for longer. This has to cause a little bit of angst at a time where there is a belief, or there used to be a belief, that back in the day, the longer inflation remained high, it would become embedded.
There's an obvious split on the committee right now. Just officially, they're very good at covering it up every time there's a meeting. But there is an obvious split. Bowman's talking about more hikes. Kashgari's saying we're not done. New York Fed President John Williams is doing the rounds, engaging the prospect of rate cuts next year for very obvious reasons. I get all that. He's just trying to say we don't want policy to tighten as inflation falls, and we don't want it to become more restrictive. But when you start engaging that conversation, when you start embracing the prospect of a soft landing, that's a very, very different view to where we were 12 months ago.
Which is a reason why people are trying to game out whether inflation can remain higher, because this is going to be a more dovish Federal Reserve. Do we see that pushback percolate out and that dissent percolate out a little bit more next week? It kind of feels like maybe, because at a certain point you can't just sit and wait. You get behind the times, and you have to get ahead of it.
Jackson Hole, a week away. Joining us around the table here in the studio, Stuart Kaiser, the head of US equity trading strategy over at Citi. Good morning, Stuart.
Good morning.
How long can Goldilocks last? HSBC's question, not mine. HSBC just asking that question seconds ago. They say continued disinflation and stronger than expected growth in many DMs argues for a continued risk-on stance. Does it?
I think in general it does. I mean, big picture, if the labor market in the U.S. remains strong and core CPI continues to ease, I think that's a good backdrop, for risk assets. I think the issue we're having now is, frankly, expectations. If you look at what's happened over the last month, you had a reasonably solid earnings season, but the average stock that beat EPS was unchanged on the day. You had, a solid payrolls report, the market traded off. You had an easy inflation print, and the market was flat. So, yeah, I mean, there's a lot of good news out there, but the market, I think, has become a little callous to it, which is kind of not good for risk reward in our view.
Michael Harnett talked about this, Lisa, over at BFA in the fund manager survey. Their line was basically bear positioning was a strong tailwind for risk assets in the first half, not the case in the second half. Their fund manager survey, you mentioned it yesterday, least bearish since February of last year.
Yeah, cash allocations coming down, and we heard that to start the show, basically. Take the cash, you might as well put it into risk, because why not? You might as well get the upside surprise if the economy is strong.
You put it into tech at the start of the year. You did, Stuart. Many other people didn't. There was that pool of negativity to feed on to drive tech higher after a brutal year in 2022. Are you sticking with that trade?
It's a tough call right here. I think, yes, as a base case, we still like tech and growth. We still think that can work, because we do ultimately expect the labor market data to begin to weaken. And I think in that environment, that's kind of where you want to sit. Obviously, the last month has been pretty tough for that trade, particularly because yields have risen, pretty sharply. And that's impacted tech, I think, more than other sectors. And also this expectation story. If you're worried about high expectations, that's clearly very acute in the tech space. So I think you are fighting expectations. You're fighting performance. And right now, you're fighting higher yields. But if you do think economy can weaken, and that should hopefully put a cap on yields, then I think tech is a place that you want to be in that case. But certainly the past month has been a tough ride for us.
Can we just talk about quickly, just pause, cash on the sidelines? This is sort of the misnomer that everyone keeps talking about. Oh, there's so much cash on the sidelines, all these people who aren't invested. Cash is great for some people if they're earning 5%. So at what point can we say the cash on the sidelines has been used up?
I think it's a great question. I mean, if you look at retail money market balances, those are up $600 billion since April of last year. $600 billion is a big number, right? But to your point, you're clipping a 5% coupon on that. And clearly not all of that 600 will go into cash. A lot of that's probably come out of traditional bank accounts and got into money market funds to get that yield. So I think the question is, to release that money, what has to happen, right? Either you need to get yields lower so that 5% isn't as attractive, or you need to have equities continue to perform the way they are, and you get sort of a FOMO, situation on the equity side. It does feel like equities are topping out a little bit, so I think it's going to be hard to dislodge that money.
To the sentiment point, at what point do losses become self-fulfilling? At what point do losses spur a question to this whole Goldilocks, to John's point, and FOMO feel that we were hearing about for the past couple of months?
Look, I mean, if equities start to move a little bit lower, yeah, that's going to dent sentiment. I don't think there's any way around that. You know, tech has performed poorly, but frankly, the S&P isn't that far off its highs. So, you know, it's interesting. Last year, in a high volatility environment, the moves we've seen recently would have not really registered, right? But July was the lowest realized volatility months that we've seen since December of 2019. So you get into August, you get a little bit of a blip, and it feels, I think, a little more painful. But yeah, I think, you know, one of the things we were a little bit worried about is, you know, a lot of folks were very defensive in hedging earlier in the year. That hedging did not work out. It cost a lot of money in terms of premium paid. The market's probably less well hedged today, you know, than it was probably 3 months ago. So to your point there, if we do get some losses, the market is going to be a little more surprised by it, or probably a little more disrupted by it than it might have been earlier this year.
Let's finish on where the negativity is now. It's in China. Everybody that comes on this show is so downbeat on what's happening in the country at the moment. The data's bad. The data you can see, you're not going to see much more of it on the youth unemployment side. I've got no idea when that changes. The data this week basically led to a policy response by the Chinese central bank to cut rates by the most, I think, since 2020. This is typically the time to lean into Chinese equities when people are so downbeat on what's happening there. Is this that time?
You know, we're not there yet. You know, I think at least me personally, you know, we're pretty cautious on China. But I think there's three aspects of the China story. There's 2 weeks ago, everybody was celebrating China's exporting deflation. This is going to help the Fed, right? But that sort of ignored the flip side of it, which is you're losing a global growth impulse. This week, the discussion is much more about the growth side and to what you were discussing earlier, which is a sentiment issue. And I think the sentiment issue, frankly, is what's going to keep people out a little bit. You know, foreign investors, I think we're not happy with how they were treated by China over the last couple of years, and I think it's going to make money, you know, kind of slow to re-engage in that space. So I think, to me, the sentiment is very hard to predict. The growth versus inflation trade-off, I think, really just has to do with what the market narrative is at any given point in time, right? You know, if 2 weeks ago was an inflation narrative, it's good. Now it's a growth narrative, it's a little bit bad. But I think we're generally, you know, being fairly cautious about putting money into China. The flows that we've seen are much more options-based, high payout type stuff, you know, limited risk, you know, type flows going into China. And we've discussed this in the past. The evolution of that Chinese trade this year has been, you know, or over the last 12 months, have been very, very fascinating. And right now, I think people are a little bit cautious to put money to work.
There's a question about whether or not to put money to work in Chinese equities. There's another about the read-through effect in the United States for companies that are leveraged to China. And then just more broadly, I think about the fact that this wealth manager missed payments on several of its products, that you're dealing with a housing market that doesn't see a light at the end of the tunnel. At what point does that have contagion that percolates outside of China?
It's a good question because, you know, I think initially, or stage 2 or 3 of the China trade was, I'm going to own Europe and I'm going to own luxury goods that sell into the China consumer, right? So, you know, certainly those type of stocks would be under a little bit of pressure given the lack of spending growth that we're seeing in China. So yeah, look, it's an impact. If you look at the foreign direct investment in China, it's come off a little bit. U.S. companies are clearly not putting money, you know, directly in there for luxury goods, and you'd probably throw Apple into that category and Tesla as well. You know, the domestic demand has been a headwind. So yeah, it is a risk, and I think that just gets into this global growth narrative of when does the benefit on the inflation side get outweighed by the sort of detriment on the growth side.
Well said. I'm just looking at Target on my screen right now, slightly distracted. It's up by 8.5%.
I don't get
off
it.
the back of this.
Do you understand it?
One of those stories that if you told me the earnings before they came out and then said, guess what the stock price is going to do? I'd be like, well, they've cut the outlook on profit, so that's not great.
That's what I
But we like
too.
the second quarter rebound for profit.
I personally think this is just where the expectations have been set. Because if you look at those shares, they're down considerably on the year. So at a certain point, if they're not hemorrhaging money and throwing all in, you know, some negative news, I guess it's positive. I can't really read it any other way.
What can I learn from a move like that?
Well, the thing is, you say Target. If you said Target, it would be much more understandable, the type of move. But hey, look, this is the important part of earnings, right? It's what happens with the consumer. We had tech early.
Sell to tourists over in China, couldn't they? Target, part of LVMH, some kind of collab.
Yeah.
What were you said? Did you say they sell sinks?
No, you were the one that said
Oh,
that.
I
I
was
said
asking.
they sell, I know, the soap that goes on sinks. I can affirm that.
Nice.
Yeah.
Okay.
News you need to know.
Stuart, good to see you. Stuart Kaiser, City, thank you. Thank you, kinda, right? Kinda.
That's
but
great.
not really.
I'm going to go buy a sink.
Every guest that comes on this show, they're like, thank you.
Yeah, sort of.
I think.
I think I'm going to run away now.
I'm like, thank you, and I'm kind of sorry. Equities on the S&P 500 shaping up as follows. Let's check out the equity market and the bond market too. Yesterday, the bond market, Treasury yields, post-retail sales in America had a little sniff of 430 again. Didn't get there. Backed away on a 2-year, breaching 5% for the first time since early July. That also backing away. Yields lower by a couple of basis points on a 10-year this morning. 418.56 on a 10-year. In the equity market, negative on the S&P 500 by 0.1%. Coming up a little bit later in the next hour, we'll catch up with Joseph Quinlan of Maryland Bank of America Private Bank. Looking forward to that conversation. And at some point this morning, in fact, maybe we do that now, sneaking in a little bit of football. Lionel Messi, is that 9 goals in 6, Stuart?
Yes.
Have you got the
He goes
subscription
right to him.
to Apple?
I have not gotten the
Are
subscription.
you tempted to buy it because of what he's doing?
No, I'm not.
I've thought about it. Yesterday, I thought about it. I considered
this
it.
actually bothers me because you tweeted over the weekend the Premier League schedule and all the games are on Peacock.
I know.
It drives me nuts when they put them on Peacock.
I know. It drives me nuts when I don't know where they are. So that was like my public service announcement for everyone else who gets confused about where the games are.
But don't people get bored if somebody is so dominant in the industry? Isn't it sort of like an unfair fight? Isn't it better when there are rivalries and there's actually somebody who can go against him?
Yes and no, but it's nice to watch one of the world's greatest ever players just on cheat mode in the MLS, just having fun and just finding it easy. I'm enjoying that. I'm enjoying the highlights. I'm this close to paying for a subscription.
So you haven't
I'm not
actually
there
watched
yet.
the whole game.
I haven't
There you
done
go.
it.
So
I
yeah,
haven't done it yet.
it's basically
I'm
a
being open and honest
celebratory,
about
like
that.
sort of, victory lap
The
rather
whole
than.
point of him being here for the likes of Apple was to get people like us to subscribe to MLS. And
Okay.
I'm not ready yet.
But as a long-time watcher of football, isn't it sort of highlighting to you the lack of competition in
Yes.
outside of Europe?
Yes.
I'm being very
one.
diplomatic.
But I will say this too, that's changing. Saudis are making a big push. No idea what's going to happen there. The power of this country. If this country decides to flex its muscles with this sport going into 2026, it could be huge. If it decides to flex its muscles, you're just getting a little hint of that now. And look at the attention it gets. I'd like to see a whole lot more going into the next World Cup, and hopefully we do.
Public service announcement.
Hopefully
by
we
Jonathan
do.
Farrow.
From New York, this is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation? And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
We have more to do with inflation, though. It's just about 3% now. It's predicted to go lower than that. We're near the lowest point in over 2 years. And at the same time, We pay for low-wage workers has grown at the fastest rate in 2 decades. Wages are growing faster than inflation. Folks, that's Bidenomics.
President Biden speaking at an event in Milwaukee. There's a bit of a PR tour on the 1-year anniversary of the Inflation Reduction Act. Janet Yellen leading that effort in many ways in an op-ed today in the Wall Street Journal. Here's the quote for you. 1 year ago, President Biden signed the Inflation Reduction Act into law. It's the boldest climate action in the nation's history, one that pushes us forward towards a net zero economy by 2050. The Treasury Secretary going on to say, over time, the Inflation Reduction Act will drive down the cost of clean energy technologies, Lisa, which will boost their adoption and reduce emissions globally.
Is it a coincidence that President Biden is in Milwaukee doing this tour? I'm just saying this is coming a week ahead of the Republican election, the Republican campaign for the primaries and the debate that's going to be held in Milwaukee. You just have to wonder.
They've been really strategic about where these events take place, you know.
Yeah. Oh, yeah.
Really strategic.
To send a lot of messages.
They've picked out certain politicians who voted against this, turned up in their district, that kind of thing.
Yeah, people who were against this and then have benefited tremendously from it, and a lot of people have felt the money in a positive way. So they are trying to go around. I don't know. It feels like exactly what you said, basically, you know.
Oh, it's right on.
Yeah.
I think you're on the money. I do. I think you're on the money. AMH joins us now. It's happening. She's back. Anne-Marie Hordern, Bloomberg Washington correspondent. AMH, welcome back. I think that was 2 weeks, something like 2 weeks. But you're lucky TK's not here, so you're not going to get bullied about this.
All the more power to you.
Good for you.
You go.
For bringing that European work ethic to Washington, D.C. Anne-Marie, let's talk about this PR tour.
It was under 2 weeks,
I
for
know,
the record.
I know. Okay.
Come on. It's a wonderful
What was
thing.
it? A week? 10 days?
A week and a half.
A week and a half.
Days,
Okay,
yeah.
2 weeks.
It's
cool. Anne-Marie, this PR tour, can we talk about how deliberate they've been about where they choose to go to deliver some of these speeches?
Yeah, absolutely. You just mentioned, obviously, Wisconsin yesterday. This is coming just days ahead of the Republican primary debate. We're going to have a flood of Republicans going into the state, touting how they see the Biden agenda working and how they feel that it is not working in terms of the economy and advancing the country forward. You just had the Treasury Secretary in Nevada. These are obviously key swing states that Democrats are looking at ahead for 2024. And the issue the Biden administration faces is that time after time, poll after poll, there was just a recent CNN one that shows that more than half of Americans don't think the economy is moving in the right direction and is still rising costs that they are feeling. And when it comes to the Inflation Reduction Act, which Biden recently quipped that maybe he shouldn't have even called it that because it didn't really explain what he was trying to do for the American economy, less than 3 in 10 Americans, according to a recent Washington Post poll, even really understand what it means. Less than 3% actually are the only ones that understand. Sorry, it's the majority that do not understand what all these tax rebates mean, how you can use them towards your home. So they have a big PR problem, and they realize that, and they're trying to advance it today on the 1 year mark, but also going to key places like Wisconsin, like Arizona, like Nevada to talk about it.
Anne-Marie, when you talk to people within the administration, what is their frustration about getting their message across if, as you say, people are focusing much more on price increases and a feeling that the economy is not going in the right direction?
Well, a lot of individuals will talk about what happened with Obamacare, and really the criticism there was that President Obama didn't go out on the road and sell this economic agenda. So they are trying to fix that with the Biden administration. The issue is the rhetoric is not landing. When individuals are concerned about basic needs, paying for groceries, those costs have risen over the past year, paying to pay gasoline in your car, they don't really want to hear about buying a brand new EV and the tax rebate you can get from that. A lot of Americans could not afford a brand new electric vehicle today. And I think that's the mismatch that what people are feeling on the ground, especially outside the Beltway in places like New York or California, versus the rhetoric that the admin is putting forward.
When it comes to inflation, this president has been one of the most union-friendly presidents in history. Right now, the leader of the United Auto Workers is asking his members to authorize him to call a strike as he negotiates with General Motors and Ford and Stellantis. What is the administration's view? When do they start cracking in terms of trying to pay some of the wage increases versus celebrate them outright as workers gaining against the corporate profits that they lost out on for so many years?
Well, I imagine this message from the UAW president last night on a Facebook Live is going to cause more consternation in the West Wing than already we have seen. And we do know that the White House is concerned because they said Gene Sperling is now going to be this liaison between the union and the White House, as well as the big three auto companies, to try to come to some form of consensus. And Biden is also already vocally, with a statement this week, urging an agreement. So already you could see the White House is concerned about this. And what you see from UAW is that they're ready to at least have on the table. They want to be able to get their workers to say, yes, you can use as leverage. It doesn't mean they're going to strike, but you can at least have leverage that you will walk out. And time is tough here. You know, we're in the middle of August, where a lot of individuals like myself, and I'm sure you too as well, will take these vacations. And September 14th is when the deadline is. So time is of the essence to get this done. I think when you see the White House come out with a statement already this week, they are concerned about this. And there is a line here that really connects these two stories. Biden wants to go out and talk about electric vehicles. The electric vehicle path forward, electrifying the grid, is something that has caused great anxiety with the UAW workers, and they do not want to be left behind.
MH, you're hitting the ground running. We're a week away from that first debate for presidential candidates in the Republican Party. How do you think some of this is going to play out on the debate stage? Away from the controversy around the former president, how do they get these unions on their side?
Well, already, when you speak of the former president, Donald Trump, he saw that window. He realizes the concern the UAW workers have about electric vehicles and what they could potentially be left behind when you see the subsidies coming out from the federal government to help the EV industry. And he said he bashed the Biden administration, and he's trying to vie for the UAW workers. Right now, that union, although they endorsed Biden in the last round, they have yet to say who they would endorse for president. So you can imagine every potential candidate, every candidate on that stage next week in Milwaukee is going to want to talk about this and try to vie for their vote.
MH, thank you and welcome back. It's good to see you. Anne-Marie, you've been missed. MH down in Washington, D.C., thank you. This article, this op-ed from the Treasury Secretary Janet Yellen is pretty intriguing. So I did a word search on it. Just search for the word inflation. Comes up 10 times. Yeah. Every single time is just when she refers to the name of the bill, the Inflation Reduction Act. The whole of the piece is not about inflation at all.
Okay. This is like rubbing in because President Biden came out and said, maybe I should have named it something like, you know,
a prosperous
Invest in
year
America.
for the Inflation Reduction Act.
Right.
And this article is not about inflation reduction at all.
Let's be honest. This bill was not about necessarily targeting inflation so much as investing in certain infrastructure. I mean, even the president has admitted this, that eventually could lead to certain efficiencies, et cetera, et cetera, et cetera. So here is the question. As they try to repitch this, how do they gain the upper hand at a time where, you know, there was a lot of pushback at the time from opponents about the name and about exactly how it was getting through?
Well, this is the rebrand effort, isn't it? It must be frustrating that you've got to keep calling it the Inflation Reduction Act and then talk about nothing associated with reducing inflation.
You know, yes, probably. I would guess that one might assume that would be the case.
You're so diplomatic this morning. Right?
That's just me, queen of diplomacy. I do think that it's going to be a hard diplomatic needle to thread, though, when it comes to some of the labor representation at a time where inflation, not just the Inflation Reduction Act, is a preeminent concern for voters. How do you then dovetail your support for wage increases that supersede what we've seen in decades, and at the same time talk about policies that a lot of union members feel are completely antithetical to their role?
I imagine the candidates on a stage at the debate next week will have a very different definition for Bidenomics, won't they?
Of course.
They're going to get in front of some of this.
And this is going to go back to this question of the blue collar and the Rust Belt and where the votes go, because we saw those go to Donald Trump. We saw those go away from the Democratic Party for the first time in decades. At what point does that continue into a cycle where there's a different leader in the party, potentially?
That first debate, a week away. If you're just tuning in, welcome. Your equity market's slightly negative on the S&P 500. Story of the month in the market, arguably what's happened in the bond market. Yields up, up, up and away. Close to 420 this morning, just backing away by 2 basis points. 418.56. Up next, Greg Peters of PGIM, fixed income.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Tony Dwyer of Canaccord crushed me yesterday. You know what the new humble brag is on Wall Street?
What?
Mid-interview, drops in what his mortgage rate is. Mid-interview.
Okay. Do you think that was
Mid-interview.
deliberate, or do you think that that's just, you know, how you took it?
He just wanted to let us know. I think that's the new way of establishing credibility with clients.
I logged it
That's what I would do.
Yeah.
If you're at home, ask your financial advisor what their mortgage rate is. If it doesn't have a 2 handle or a 3, do you trust them with your money?
Just pro tip. It makes certain people angry when they hear about what other people's mortgage rates are. And if you do that, it might alienate said potential client more than
You
otherwise. Just
reckon?
saying.
I think it's a real question of credibility.
Really?
What do they have? Is it a 2 handle? Is it a 3? Are they responsible with their own money? You know, can you learn a lot from that? Which is why I think Tony slipped it in yesterday
never even
into
told
the
you
conversation.
But
2 handle. I know it's a 2 handle.
yeah.
You got 2 handle written all over your Brahma. Come on.
It's credibility.
You're a
It's
2
called
handle,
credible.
2 handle
Kinda
kind of
guy.
person. Oh yeah, without a doubt. TK on the other hand.
It's 11%.
No. Equities right now in the S&P 500. Equity futures are just about negative, basically flat over the last couple of days. Monday was decent. Tuesday was worse. We took it all back. We're unchanged. On the NASDAQ, we're down by about 0.06% on the NASDAQ. Really tame stuff in the equity market. Today, at least. Nothing tame about the last month in the bond market. Let's go through the 2-year, the 10-year, the 30-year, and look at the 10-year specifically. So we're just south of 420 right now. We're down 2 basis points at 418.95. Just some levels for you. Yesterday, really close, just short of 427, following that upside surprise on retail sales. The intraday high for the cycle, Lisa, back in October through 430, which is basically where the 30-year is now. But this hasn't backed away. In fact, it's been backing up, yields up.
And this is reversing a lot of what we